Welcome to the conference, The Next Global Financial Cycle in a Divergent Global Economy, jointly organized by the Central Bank of Peru, the Reinventing Bretton Woods Committee, and the Inter-American Development Bank. The event will have the chat open for the questions and answers. Please send them throughout the event. We are pleased to have Mr. Julio Velarde, Governor of the Central Bank of Peru, Mr. Eric Parrado, Chief Economist of the IDB, and Mr. Marc Uzan, Executive Director of the Reinventing Bretton Woods Committee, with opening remarks. Mr. Velarde, the microphone is yours.
Thank you very much. I would like to welcome you all to this. Actually, it's a Cusco meeting, but it's the second year that is in a virtual format. We started this meeting just during the crisis of 2008-2009. And we always had a support since the start of Marc and Reinventing Bretton Woods. Marc is not only a very good friend and excellent economist, but probably he's also a figure within the central bank community because of his strong participation in almost any conference that has to do with central banking. Thank you again, Marc, for your support. I would also like to thank Eric Parrado and IDB, which has been supporting this seminar during the last years. I would like to welcome you all, the chairs, the speakers, and all participants to these meetings. We are going to have 3 sessions, much briefer than when it was in Cusco. And I believe we have 3 interesting topics. The first is, we don't know, the end of the great moderation, but it may happen. I don't want to talk much about it because we are going to hear the speakers. I'd like to say not only José Uribe chair, but Ilan, Eichengreen, Felipe, Larraín, David Hauner, and Gruenwald for what they are going to say, that I'm sure is going to be pretty interesting. And then the second session will be something, the next global financial crisis. Let us hope it doesn't come. But probably we have less to do with banks and more with capital markets in any case. But it's something that is going to be discussed by Oganes, Elena Rybakova, Maurice Schuler. That chair is going to be by Manuel Ramos-Francia of CEMLA. And the last session will be the central banking in the new era. That's going to be shared by Eric Parrado. One deputy governor, Margarita Delgado, is going to take part, and 3 governors. I am sure we are going to hear pretty interesting things. And with that, I ask to finish welcoming you again and thanking you again for taking part in this event. Thank you very much. Eric?
Thank you very much, Governor Velarde. It's a real pleasure to be here, at least virtually. This is the 5th consecutive year that we co-organize this event with the Banco Central de la Reserva del Perú and the Reinventing Bretton Woods Committee. As Chief Economist of the Inter-American Development Bank and on behalf of the Financial Stability and Development Network of the IDB Research Department, I want to give you a warm welcome to this event on the next global financial cycle in a divergent global economy. This is the second year, as you said, Governor, that we are hosting this conference in an online format. The pandemic is still not over, but in some parts of the world, people are starting to return to their pre-pandemic lives, albeit at a different pace. In the United States, we're slowly going back to the office. I am in the office right now, while many challenges remain in Latin America and the Caribbean. However, even in the region, the vaccine rollout is now gathering speed. So there is some light at the end of the tunnel. In this context, at the IDB, we have a strategy to chart a robust and sustainable recovery path in our Vision 2025. And we're in the process of ensuring that we have the necessary tools to help the region come back from the pandemic in a better shape than when it started. Along with many other areas of life, the pandemic also had a significant impact on our economies, challenging, among many other things, the stable monetary policy frameworks across the region. Fortunately, central banks have been part of the solution to the current crisis. They have been cautious and creative in maintaining the stability they gained in the past. And just like they have been throughout this crisis, central banks will continue to be key players in the recovery. Of course, a necessary condition for this is central bank autonomy, as many of you know. Yet, the advantages of this autonomy are not as obvious to many citizens on the street. One of the reasons is that inflation has been low and stable for the last decade across most countries in the region, especially those with inflation targeting regimes. Most people haven't had to worry about losing all their savings to inflation from one day to another. To make sure this remains like this and to rally support in these times of monetary stability, it's key that central banks step up their communications efforts and explain why they need to stay independent to safeguard this stability. They also need to communicate more and better about the scope, limitations, and benefits of central bank policies in general to regain the support of people and politicians. By communicating better and about their work and goals, central banks can clear up misunderstanding about the policies and instruments they use to uphold monetary stability. The stakes are high. If central banks lose public support, politicians may challenge their autonomy, especially if they have no reason to fear public retribution. To maintain central bank independence, communication is really the best instrument at our disposal, especially during periods of political uncertainty. But before I hand it over to Marc, let me thank Victoria Nuger for continuing to build the relationship with our partner institutions and for her continued work in organizing this event. I also want to thank Mariela Segnede for making this event technically feasible and the whole team at the Banco Central de la Reserva del Perú, especially Luis Larrañaga, Francisca Pin, Carlos Pereira, and Gladys Chong. I'm excited for this great conference, and I will see you later today. Thank you very much. Marc, please.
Thank you, Eric. Welcome to the 13th annual conference. As the governor said, unfortunately, this is not in Cusco, but it's going to be in a virtual format. I want to take this opportunity at the beginning really to thank Governor Julio Velarde for the last 13 years that we have been putting this conference together, and also the IDB and Eric Parrado and all his team who make this conference possible. We have been working closely with all your team to provide today, I think, a very interesting program, topics that are not only on the short term, but also the medium term, and what are going to be the challenges central bank will be facing. As you mentioned, Eric, in 2021, the world economy started to have some signs of recovery. But this recovery are multi-speed and divergence, and uncertainty remained quite elevated. Countries continue to support their economic outlook with fiscal and monetary stimulus, and of course, different between the advanced countries and emerging markets. And some central banks have also started to look at the long-term scar of the pandemic. So the world is bracing for bumpier global cycles, marking a potential reversal of the Great Moderation era. What are the stakes that the inflationary pressure that we are seeing in the US are transitory or more persistent? How does the US consider the spillback of the implication of its monetary policy decision to the rest of the world? How to manage divergence growth path between advanced countries and emerging markets, given the uneven pace of vaccine rollout? Considering the global public good nature of vaccine availability, what are the possible cooperative arrangements to facilitate equitable vaccine rollout? As countries move toward a post-pandemic global economy, they are facing lingering issues as well as new challenges in the medium term. Some concern the central banks, but there are developments outside their ambit of central bank control that are becoming important due to the implication of central bank. The shifting landscape makes relationship and interactions between and among monetary policy, financial policy, fiscal policy, climate change, and digitalization of money more intervened. So this high-level conference is a combination of panel discussion on this urgent issue of post-COVID-19 that central bank will be facing in the years ahead, that will have major ramifications for the functioning of the international monetary system. And I will add here some questions that will be on the agenda, but it will be also the questions for central bank governor in the month and the years ahead. Can a sovereign digital currency be designed in a neutral way that attenuate fears about monetary sovereignty, disintermediations, and disruptions in banking activities? What are the design features that are least disruptive? how should central banking community proceed with the issuance of digital currencies? When previous crises, as the one we in fact started in 2009, the first conference, it was all financial origins, but climate change could be the defining crisis of the future. It could fundamentally change central banking as it affects asset valuation, balance sheet of financial intermediaries, and expectations of economic agents. Do central banks see the possibility that future crises will be driven by climate change dynamics? What is the role of central bank in moderating the impact of climate change, environmental degradations, and the transition to a low carbon economy? So indeed, this is a new era for central banking, and I'm looking forward for the last panel of today, and also for macroeconomists and for think tanks like us. So thanks for all of you for joining us again here in a virtual format, and we all hope that we will be able to come again to Peru and to Cusco and to visit your beautiful country. Thank you very much. Over to you, Eric.
Thank you, Mr. Uzan, and hopefully we can get together in Cusco. Now we'll have the first session, Divergent Recovery Path in the Global Economy, the end of the Great Moderation. The chair for this session is Mr. José Darío Uribe, President of FLAR. Mr. Uribe, the microphone is yours.
Thank you very much. Good morning, everyone. I want to start thanking Banco Central de la Reserva de Perú, the Inter-American Development Bank, and the Reinventing Bretton Woods Committee, and in particular to Julio Velarde, to Marc Uzan, and to Eric Parrado for inviting me to be the moderator of this session. Thanks to Julio Velarde's kindness, I believe that I have had the privilege of attending all of the 13 annual conference organized to date, mostly in Cusco. And I have been witness of the great academic level, their impeccable organization, and the enormous kindness of their host, the Central Reserve Bank of Peru. The title of this session is Divergent Recovery Paths in the Global Economy, the end of the Great Moderation. No doubt the subject is very well chosen. The recent recovery of the world economy is strong, but uneven, and in many parts fragile. The United States and China are growing notoriously, and if they continue to do so in the near future, they will reach the growth pace they were showing before the pandemic. On the other hand, many other countries in Asia, Africa, and Latin America are still struggling to reach the production and employment levels they had before the pandemic. And if they are lucky, they will maybe reach it by the end of the year or by the next year. In view of the markedly uneven economic recovery, we may expect to find both real as well as financial spillovers. The strong recovery of the United States and also China, particularly, benefits the country with greater international ties with these two countries. South America, for example, is benefiting of higher commodity prices. However, there may be reasons to believe that currently some of these ties are weaker than they have been in the past. Likewise, there are also potential financial spillovers. Inflation and inflation expectations in the US, partly explained by very expansionary monetary and fiscal policy, can lead to monetary policy surprises, which could drastically affect interest rate, stock prices, and capital flows to emerging economies. However, there are also motives to envision a scenario of calm international financial markets with continued low interest rates, high asset prices, and abundant international liquidity. In conclusion, the issue of divergent recovery paths in the global economy is very complex, of great importance, and with very high uncertainty. This is particularly so for emerging economies, many of them with very strong vulnerabilities. To analyze these topics, the organizers have brought together a very select group of speakers. It includes participants with extensive experience in academia, central banking, finance ministers, private international banking, multilateral institution, and rating agency. Each speaker will offer an initial presentation of up to 10 minutes, and after the presentation, we will open the floor for comments and questions. Actually, I remember that the questions and comments should be sent by the chat, written in the chat. The first speaker is Ilan Goldfajn. Ilan Goldfajn is well known by most of us. He's currently chairman of the board of Credit Suisse since September 2019. He has a long tradition in central banking. He was deputy governor starting this century in the Central Bank of Brazil, and he was governor from the Central Bank of Brazil. He has a long career also in the academia. He was professor in the US and in Brazil, and he occupies also position in the International Monetary Fund and many other parts. I will not extend me in the history of professional history of Ilan. I just say, Ilan, you have the floor. Go ahead, please.
Thank you, Jose. Thank you very much. Very nice to see you, even if it is only virtual. It's also very nice to see my friends and organizers of this very nice conference that has a tradition of 30 years, from the reinventing Bretton Woods, Marc, Uzan, that long time been around with us, and Julio Velarde, which my central bank years were very nice colleague, and I would like to thank Eric Parrado for the IDB, also for the organizers. The topic of this session is about the divergent recovery. We're talking about the reversion of the great moderation. My 10 minutes will be spent saying that this doesn't look like moderation going ahead. Not in markets, not in growth, and certainly not in terms of inflation. I would like to make three main points. The first point is the risks that the global economy and emerging markets are facing from excesses. Excesses coming from in the recoveries, excesses coming from fiscal and monetary policy, and certainly excesses that are translated into markets. And there is a risk there that we are going to face more volatility going ahead and much less moderation. Given that I'm going to talk about inflation, I would like to use a little bit of the experience of emerging markets, central banks, leading with higher inflation. We had much more experiences of inflation bursts, inflation going up. I come from a country, Brazil, that not only faced hyperinflation, but once in a while you have like higher inflation and you have to deal with it in an inflation targeting regime. And I would like to somehow summarize part of this experience. And finally, I will concentrate on emerging market and do some of what I think are the post-COVID challenges for emerging markets. So let's start with the risks of the global inflation and market excesses. Inflation, I think inflation is global. I mean, we're seeing inflation coming in Mexico, in Latin America. In Brazil, we are with inflation 12 months, 8%, higher than 8%. There's some optimism that will come down to 7% by the end of this year, maybe to 5% next year, but this is way above the target. In the US, we're talking about much higher inflation, both at the core, headline, global inflation, from the numbers of Credit Suisse, we're talking about higher than 3% for 2021, between 3 and 4%, which is very high. It's one of the highest in the last several years. Of course, we are having a recovery. I will say that we are coming from a V-shaped recovery. Partly the shaped recovery is based on the exceptional fiscal and monetary stimuli, which is very good. We're having in the US and growth, our numbers say something like 7% for this year, 5% for next year. China, which some people are more concerned maybe decelerating, but 8% this year, then 6% next year. Very strong recovery everywhere. Countries like Brazil, 5.5% growth this year. This is a V-shaped recovery. So what is the problem? The problem is that we have to analyze how this is coming. Why do we see this inflation? There are several explanations. One of them is there's too much stimuli, fiscal, monetary, maybe this is too much. Second, maybe it's a different demand stimulus. You have direct cash transfers, you have checks arriving in the consumer, you have people spending directly, much more government spending directly on goods and services, and that may be the difference. It could be the case that everything is temporary. This is an asymmetry. The recovery is very asymmetric, and we still need some time, and inflation is just a reaction of this asymmetry. So asymmetry, excesses, very different demand stimulus may be leading to either a temporary or voluntary. In any way, my main point here is that when you look at balance of risks, which is something that central banks have to do all the time, the risks of continued stimulating in this way are much lower than the risks, are much higher than the risk of just slowing down. If you instead of growing 8% in China, you grow 10%. Instead of growing 7%, you go to 9%. It's still good, and it's not going to give you a lot. On the other hand, if this is too much, if you have overdone it, there will be much of a volatility going forward. You'll see central banks being seen as behind the curve, running to control what they believe to be a temporary inflation, and it became a high inflation. And we know what happens is booms and busts and a huge volatility. And that is especially worrisome for markets. Today, markets are into, in my way of seeing, very stretched valuations, whether in the stock market or in the bond market or in other markets. It looks like even though people are seeing inflation, they believe in that's temporary, they believe in the central banks, they believe that this is not a major issue. And when they believe that, they tend to hedge in a very certain way. Today the hedging is in the bond market. If this is temporary and there is a risk aversion, we get a COVID-related problem like Delta just coming again, then probably the flight to quality will mean that interest rates will go down even lower, the 10-year treasury will go down even lower, and the hedging is the same hedging they have been doing for several years. On the other hand, what is starting to change this year is if the problems are on the upside, if we're going to see interest rates going up, not down, if 10-year treasury will go up, if 30-year treasury will go up, then the hedging does not work. Actually, it's worse because treasury will go up when the risk happens. And markets are a bit confused. At some point, the treasuries go up, they go down. and people don't know really how to hedge. Will I do it in the same way I did it in the last 10, 20 years, which is if something happens, interest rates will go down. This is the way to deal with the future. Or this is a different risk, which means that for the first time, a crisis will mean higher interest rates. So I believe that now we are facing a less of a moderate scenario. In that regard, I would like to say that even though sometimes inflation is temporary, as it has been for in emerging markets, and in the case of Brazil for sometimes, you suddenly get a shock coming from the currency, or coming from commodity prices, or there is a supply shock. In Brazil, we had this strike of the truck strikes, and suddenly a supply shock, which we had an inflation of 1% in 1 month, annualized 12% or more. And then you get more inflation suddenly. What do? It's temporary, you know. But unfortunately, even when it's temporary, you may lose some of the credibility. You may get inertia. Inflation may be longer than just 12 months, 24 months. It may stick around. And when you lose the credibility, when you lose it, it will make your life even more difficult going ahead. So in the balance of risks, just allow inflation to go up could not be as easy as many advanced economies may think. Finally, I want just to list some of the risks that emerging markets are facing now. First, what I just say, the global economy may not be as supportive as it was in the sense that fiscal, monetary, low interest rates, global recovery, this has been very benign this year, despite the COVID last year. But going forward, especially in 2022, I see that this could lead to much more volatility than central banks and markets expect. So the global economy may be less benign as going forward. In addition, there has been some legacy coming from the COVID years. One, some countries are more indebted because they had to overspend quite a bit in the COVID years. I say overspend, but maybe it was just spent. And it means that you had to spend it, but now you have a higher debt. Will you be able to deal with this debt in the markets? Some countries, yes, they have open access. Some countries, some middle and lower income emerging markets have less opportunities, and there is where international organizations come in. Second, we do have a legacy of the past that has become very essential. The perception of inequality, the perception of problems, social problems going forward, even though they existed all along the last 10, 20 years, the low social mobility, the perception of that the future does not look better than the present, has led to social unrest, not only in Colombia, not only in Chile, Brazil, several Latin America. So this more challenging global macro environment will be in the making, with more social and inequality issues that have to be solved. And this is not an easy task for the institutions and for the political parties in the region. So just to summarize, I'm a bit more optimistic that we are getting out of the COVID despite Delta, but I'm more worried about the post-COVID risks. I do believe that in the balance of risks, we are allowing things to go overboard, that will have more volatility in advanced economies, that if the scenario happens, it will lead to quite a bit of problems for emerging markets, for Latin America, because we are now facing issues, social issues, inequality issues that have to be solved, and a more macro moderation will have been better to deal with what we're going to face in the next few years. Thank you very much.
Thank you very much, Ilan. Excellent. We move to the next speaker, Barry Eichengreen. Oh, sorry. Yeah, it's okay. Yeah, Barry Eichengreen, Professor Eichengreen is very well known by, I am sure, by all of the participants here. And he is a professor of economics and professor of political science at the University of California in Berkeley. And he is research associate of the National Bureau of Economic Research and research fellow of the Center for Economic Policy Research. He has published many hundreds of articles and papers and academic papers, very influential. Many of them are very influential in the profession. I will not extend also in the view of Professor Eichengreen. Please, Professor, go ahead.
José, thank you. It's nice to be with you. It would be nicer to be with you in Cusco. So everybody is wondering whether normalcy will return after the virus. My litmus test for that is, when will we next be able to meet together in Cusco? There is a consensus out there about how the world will react to, how the world will be affected by the impending increase in interest rates in the United States. So I'm following the standard rule of forecasting. Give them a forecast. Interest rates will rise in the United States, but don't also give them a date. None of us know quite when, but that consensus is that there will be no repeat of 2013. There will be no taper tantrum this time around. And I want to question that. My own view is somewhat ambivalent about what's coming, but I think it's useful to ask whether there could indeed be a taper tantrum. So there are 3 quotes on this slide that represent that consensus. We're not about to see the same tantrum as in 2013 because emerging markets are better prepared. We will see a boring tantrum, or emerging markets will not be as badly impacted as in 2013 because the frameworks of central banks have improved. Or unlike in 2013, the global economy is in a better position to accelerate today. We anticipate healthy demand from developed markets as this recovery unfolds, supported by strong consumer and corporate balance sheets, making this a different environment for emerging markets than in 2013. Or as that financial expert, Alfred E. Newman, this is a joke for the Americans among us, and I suspect I might be the only American on this call, a joke for me. What me worry? Why should I worry about what happens next? One standard answer to that question about why we shouldn't be worrying is that external positions are stronger than they were in 2013. The current account deficits of the Fragile Five were more than 4% of GDP in 2013. They're less than 1% of GDP now, making for less dependence on external finance. External debt payments falling due are less than foreign exchange reserves for most emerging markets, making those external debt payments more financeable. Real exchange rates are at more realistic levels today than they were in 2013, which is helpful for exports. On the fiscal side, deficits may be large, as Ilan emphasized, but emerging markets have deeper local currency bond markets to fund them. If interest rates rise, as they did in 2013, the factor causing those higher interest rates, as emphasized in one of those quotes at the beginning, this time is going to be strong US growth. And unlike in 2013, the Fed is unlikely to spring a surprise. It's been careful to telegraph to the markets how it views the world and what is likely to be coming. Portfolio flows into emerging markets have been surprisingly large, but still they've been somewhat smaller than in 2009, 2012, meaning that positioning is not as heavy as it was back then, suggesting that rebalancing out in response to higher Fed rates may not be as pronounced as it was in 2013. And above all, most emerging markets have improved fiscal fundamentals, better anti-inflationary credibility, again, as emphasized in those opening quotes. This is evident in the fact that governments in many emerging markets were able to raise spending. Central banks in many emerging markets were able to cut interest rates when the pandemic and the recession struck. So as someone who's followed Latin American history for a long time, for me, this is the most striking and impressive aspect of the current crisis, how emerging markets have had more policy space this time around. And they've been able to respond to support spending in a crisis, much unlike what they were able to do in previous crises. So this accommodative policy response is quite different from historical experience. And now we see similarly emerging market central banks trying to get ahead of the curve as recovery hopefully sets in by raising policy interest rates and reassuring local investors in Hungary, in Brazil, in Russia, in Ukraine, in Georgia. So that's the positive story about why we shouldn't expect a taper tantrum this time going forward. On the other hand, emerging markets have used that fiscal and monetary space. The subtext of Ilan's presentation is that they may have overused that policy space, raising the question of whether they have any room for maneuver remaining. The very fact that central banks in emerging markets feel compelled to tighten, despite the fact that economies in Latin America, for example, remain weak, that recovery remains tentative at best, suggests that the expectation of tightening in the United States is already having an adverse effect. And if we superimpose upon that fact the Delta variant, so I'm much less confident than the previous presenter that the Delta variant is under control and will remain under control. If we have renewed lockdowns, what will that imply for recovery going forward? What will that imply for the impact of a US taper? There are some emerging markets that have external payments coming due in the next 12 months greater than their foreign exchange reserves: Turkey, Argentina, South Africa, Chile. If economic activity does pick up in Latin America, if oil prices remain high, current account deficits will widen going forward. Fiscal deficits have been financed in part by inflows from developed market investors searching for yield. And if US interest rates now begin to rise, will that external financing continue? And underlying deficits and foreign financing needs may be even larger than the headline figures that I show you here from the IMF Fiscal Monitor due to guarantees that governments and central banks have extended that haven't come due yet, that haven't crystallized on the balance sheets of those institutions. So if inflows turn to outflows as US interest, if and when, I should put it, US interest rates begin to rise, that could become a serious problem for a variety of emerging markets. Will countries in the region be able to grow the denominator of the debt to GDP ratio? Everybody has learned to focus on R minus G, the real interest rate and the rate of economic growth. Everyone has learned to focus on that differential as a key determinant of debt sustainability. If you're Brazil, if you're Mexico, if the spread is on the order of the spread over 12-month US Treasuries is on the order of 6%. You need some serious economic growth in order to maintain a favorable R minus G differential. And there's no evidence of that yet in Latin America, for example. And there's the Delta variant again, which could have significant implications in terms of lockdowns and negative impacts on economic growth. So I have a reminder for you here that in developed economies, new COVID cases have come down. In emerging markets, ex-China, I have stolen this graph, as you can see, from JP Morgan. They remain elevated. So there is reason for concern, especially throughout the world, but especially in emerging markets, and especially if you're one of these economies down here with a small share of the population vaccinated and slow progress in terms of additional vaccinations. I think all these are reasons to be cautious. The Fed has been doing its best to telegraph its intentions to avoid surprising wrong-footing investors, to avoid destabilizing financial markets, including emerging financial markets, but the Fed may yet be forced to spring a surprise. So I'm on team transitory, that the inflation we've seen in the United States, a lot of it is transitory, but I'm not a confident member of team transitory. I worry about that inflation outlook going forward. And given the other considerations that I've just outlined, I worry about what faster than expected normalization of the level of interest rates in the United States could imply for financial and economic conditions in emerging markets going forward. So let me stop there.
Thank you very much, Professor. Before moving to the third speaker, I would like to remind you that the questions or comments should be sent to the chat. And we will move to the third speaker, Felipe Larraín. Felipe Larraín was a Minister of Finance in Chile and Vice President of Chile. He is currently Director of the Latin American Center for Economic and Social Policy and Professor of Economics at Universidad Católica de Chile. He has a long career in academia, in public policy, has been advisor of many governments and many other things has been done, Felipe. So please, Felipe, go ahead. It's mute.
Okay, now we are, yes. Can you hear me?
Yes.
Yes, okay. Well, thank you very much. It's a pleasure to be here. I would like to thank Julio, Velarde, Marc, Uzan, Eric Parrado, the support of the Central Bank of Peru, the Reinventing Bretton Woods Committee, and the Inter-American Development Bank. I am here with Barry, in the sense that I will not consider this pandemic to be over until we can meet in person, and I truly miss our meetings in Cusco. It was a highlight of the year to be able to meet and have this conference with the great hospitality that was always provided by the organizers. So thanks for inviting me. I would like to share a few thoughts on these diverging recovery paths in the global economy. Certainly, we are in a recovery. We are in a strong recovery on average, but these averages hide very important differences across countries. And it is weaker for emerging markets. I would like to share some concerns and risks that I'm seeing, and I will echo some of the things that Barry and Ilan have mentioned. First, on the pandemic, I would say we are not there yet. We are not over. We have almost 200 million confirmed cases and 4 million deaths. We are truly here on the third wave of the pandemic. We are on a very strong increase in contagion in Europe, but in many cases, I was looking this morning in the US, there is a very strong increase in contagion as well. So we are not over yet, and we don't know. There could be a third wave. We hope we don't have a fourth wave, but we cannot consider we are out of this. You know, we could be slightly optimistic for reasons that I will talk in a bit. And we have a very uneven part of this divergence is a divergence in the vaccination rates across countries. It is not just an issue of being developed or developing. We have countries here like New Zealand with very low, Taiwan with very low vaccination rates. And here we need to have some coordinated action for the vulnerable countries to get access to vaccines. COVAX has been an initiative to try to make funds available for vaccination, but we need a bit more than that. So I would also mention this issue. This is a global public good, and we need to have a very significant increase in vaccination rates so we get to herd immunity in these countries. And we cannot consider that we're over. In Chile, for example, we have a very high vaccination rate, but we have neighbors that are doing very poorly on this. And it is a case of important concern. On the divergent paths, let me just say that we have this very big difference between developed markets and emerging markets. And I just took some manufacturing survey data to show that developed markets continue to perform very strongly, and emerging markets, you know, are in basically in a plateau in terms of manufacturing activity. So this is just one indicator there are many other indicators of these divergent paths. The fiscal policy response, which has been said, has been greater than the historical average, especially in developed countries. And here you can look. This is based on IMF data, that the countries that are being really able to perform better are those that have had the possibility to do very aggressive fiscal programs, like the advanced economies, which have in 2020 had about a 9% of GDP fiscal impulse, whereas the emerging markets had a much lower response. And this relates to the ability of these economies to get access to financial markets. So we have, why is this big divergence? The big divergence has to do with vaccination rates, the handling of the pandemic, also the ability of countries to do fiscal and monetary impulse, which in many cases have to do with the financial access to the markets. And this is really causing this divergence in the growth rates. For example, we have the US recession has just been categorized as the shortest recession in recent history. Only 2 months of the recession from February to April of 2020. This is an NBER. So we have very, very small recessions in countries like the US, in China, pretty much no recession, in other countries with very long recession and recovery phases. This is another aspect of big important worry. And I take just the US as just one case. Jobs, the recovery is certainly V-shaped in most cases. We have a very strong recovery, uneven but strong overall recovery, but jobs have been lost and they have not been recovered yet. In the US, we still have about 6.5 million jobs that have not been recovered since the beginning of the recession and the pandemic hitting the economy. And this is an even more worrying issue is the fact that the jobs that have not been recovered are mainly in the low-income groups. If you divide workers by high, middle, and low income, you can see that high-income workers already recovered the previous employment levels. This is really a K-shaped recovery in the labor market, and this is the middle-income workers, about 5% less, and the low-income workers have 25% less employment. So this is a very worrying issue in terms of the distribution. The recovery is also not homogeneous across sectors. I'm going to show in air transport, that these are some of the lagging sectors. This is July 2019, full of flights, and July 2021, we have very limited still flights. So this is one sector, air transport. There are many others which are lagging. Others are doing much better. So we have not only divergence across countries, you have across sectors, across groups of workers. There are many, many divergences. Let me finish with the main risks that we're seeing in this scenario. The first, I'll start with this, which is what are the risks perceived by global fund managers? Are they right or aren't they? Well, inflation is the number one. And I would concur this is certainly one of the big issues that we are. Taper tantrum, although Barry talked a bit about this, taper tantrum seems to be the second worry. Asset bubbles, COVID-19 is in fourth place, then higher taxes, a credit event. This is a global survey of fund managers. These are the main risks, and I would concur there are some of the important risks here. Let me just say a couple of things about inflation. We have inflation in the US at 5.4% year on year. This is the highest since August 2008. Expectations are, have increased, but have, in a sense, have come a bit back. So expectations, inflation expectations have not been heard as actual inflation. So we have big increase in current inflation, but probably, inflation expectations more balanced and less worrying, looking at the medium and long term. So do we have a transitory increase in inflation? There are factors in the demand side and factors in the supply side. This is a very worrying aspect, the increase in shipping costs in container costs, going from $2,000 to all the way to almost $13,000 or $10,000 to $13,000. So increasing by 5 to 6-fold. And this is a very important aspect in the current inflation. In the current inflation surge, which is a global issue, as Ilan said, it is a global issue. It has to do also with supply side shocks. This is part of the supply side shock, the transportation costs. And this has led to increases, and this is another reason to worry, in asset prices, residential property prices having the largest increase in many years, in decades. You have to go all the way back to the to the phase prior to the global financial crisis to see this kind of increases, and we have big increases also in commodity prices, much more than recovering from the levels at the beginning of the pandemic. So this is another issue that is hurting, and this is another issue for worry in the current scenario. Let me say also another case for worry is the interest rates. I will say, and I will concur with Barry here, we don't know exactly when this will happen. In fact, interest rates were increasing, but they have been on a downward slope since mainly the issue of the Delta variant is here with us, but they will eventually pick up. And this is an issue for emerging markets, certainly. Interest rates will start going up, have already done so. And it may not be the most appropriate thing for emerging markets to see the tightening that will start with central banks, and the tightening will lead to higher interest rates. With a higher inflation will also lead to these higher rates. When will this happen? It is probably in the making right now. We have this unprecedented fiscal and monetary impulse. There will be time for consolidation. When will consolidation start? Well, on the monetary side, it has already started in many countries. It will start also there will be a point to start it, in some of the advanced economies. The fiscal impulse is also with record low interest rates, which is another issue which is unprecedented and will not last long. So very much higher levels of debt. I worry also about these very increased levels of debt, which will have countries in a more vulnerable position when interest rates go up. And the Delta variant. The Delta variant, let me finish with the Delta variant. We have a very big increase in the number of cases in several economies. We have a number of countries where the Delta variant is completely dominant, not yet in Latin America. We have less so in Latin America, only a few cases still in the region, but in several other countries, we have it here. The UK is an interesting case. We have a very important increase in the new confirmed cases. We have a clear new wave in the UK at the time when restrictions have been relaxed, but very, very low number of deaths. So the bad news is we have clearly a new wave, we have a new variant, we have much lower deaths than previously. And I think to finish, this chart shows the second wave and the third wave in the UK, showing that we are, and probably this has to do with the fact that vaccination rates have been are very high in some of these economies and in some of these countries, so that the death rates are significantly lower. So we have much higher number of cases, but lower deaths. These are the worries, and certainly I think it's a very challenging environment. Let me just finish to say that one thing is the recovery in 2021, and I think there are many, many doubts about what will happen from 2022 beyond. Thank you very much.
Thank you very much, Felipe. Excellent. Now we move to the fourth speaker, David Hauner, Managing Director, Bank of America Global Research. Before joining Bank of America, David was the Managing Director, Head of the Cross-Asset Strategy and Economics for Emerging Europe, Middle East, and Africa, and the co-editor of the Global Emerging Product. He also was an economist at the IMF and has a long experience. David, please, you have the floor.
All right, thanks, José, for the kind introduction, and thanks to Marc, to the IDB, to the Central Bank of Peru, and to the Bretton Reinventing Bretton Woods Committee for inviting me to speak here. It's a great pleasure. I can only obviously second others' comments that I would much rather be in Cusco, but there we go. In terms of our own stance when it comes to Bank of America's views to the question of to what extent emerging markets are vulnerable to a potential rise in interest rates and inflation globally, basically we stand in the cautious camp. I wouldn't say we're pessimistic, but we do think that inflation is likely to be more permanent than it seems now to the consensus. We think that growth may be more transitory than it seems now to the consensus. And we think that risk assets globally are very highly valued. And we think that basically means that asset price returns over the next couple of years will likely be very low. They're likely to be negative in real terms in many countries. And we think that emerging markets are clearly in better shape than in 2013, but there's very little room for error. Now, let me just show you a couple of pictures in terms of the Bank of America forecast for global emerging markets. You can see here global GDP growth, or global emerging market GDP growth. Next year is still expected to be quite high. Clearly, there's a further recovery which is likely happening. Many EMs, even though COVID is still rampant, ultimately will experience recovery, and we'll see negative output gaps close, and we'll see actually some countries experience positive output gaps by next year. Now, we also think, however, that inflation is going to remain relatively sticky. When you look at the slides, the next chart, you can basically see that global EM inflation, particularly when you look at it from the perspective of a weighted average, which of course to some extent is biased downwards by China, which tends to have relatively low inflation. But it will remain relatively sticky if you consider where we are in the cycle. Now, we have built a global indicator of permanent versus transitory inflation. And basically the message is that, yes, a large part of the current inflation is indeed transitory, but there is a rising permanent component. And our punchline is essentially for the developed world, we're moving out of a decade where we had inflation of 1 to 2% to a decade where we have inflation of 2 to 3%, but not necessarily because of higher rates of growth, but rather because of a political change in emphasis away from fiscal stability towards greater expenditure-driven fiscal programs. And of course, if I put on my ex-IMF hat, it's mostly fiscal. And of course, we know from the literature that there's no major driver of inflation other than government expenditure, or nothing is as important. Of course, we also think commodity prices will continue to be quite elevated, a lot due to basically demand pressures, meeting relatively limited supply when it comes to many commodities. Ironically, even including crude oil, where we think that prices will continue to rise over the course of the next year on relatively limited supply and very low capital expenditure. And that, of course, also means food prices will keep going up. So that basically creates a backdrop where we think that there is going to be more permanent inflation, but it also means effectively, because we think that the recovery will actually be losing force over the course of the next 12 months, where we hope that indeed the Fed will be in the position to taper very gradually and to to ultimately delay interest rate rises towards 2024, which is our forecast. But there's very little room for error. And the major risk, we think, to the current market consensus would be that towards the fourth quarter, it turns out that inflation is much more permanent than it seems, and it could lead to major spikes in interest rate volatility. Now, on the next slide, you can see basically the recovery paths and how divergent they are. This is, of course, something that has been alluded to several times. China pulling away from the pack. Otherwise, only very few emerging markets keeping pace with the United States. By end of next year, we think that only very few, including Turkey, Indonesia, will be roughly at the same level of GDP compared to 2019 that the United States is performing at. Most other EMs are underperforming. And indeed, there are some, and particularly Mexico and South Africa, when they look at the bigger countries, which actually even end of next year will be still far below the 2019 levels of GDP. And of course, this creates also potentially very significant negative political side effects that I think have been alluded to before, in particular in combination with rising food prices. We'll probably see more countries in Latin America, and Africa, and the Middle East experience political volatility, which can only be problematic for growth and capital flows again. Now, moving to the next slide, and so that basically sort of underscores what I would say sort of is the gist of what standard macroeconomic models would show about the risk to EM currencies from a taper tantrum, and it is sort of in line with what Professor Eichengreen earlier alluded to. This is based on a probability model of the likelihoods of crises in emerging market currencies going back, as you can see, more than 20 years, predicting the likelihood of major moves in the exchange rate and or in reserves in the 30 biggest emerging markets. Turns out that clearly one of the most important variables, of course, is the current account, but beyond that, it also includes things like the credit gap, the valuation of the exchange rate, et cetera, et cetera. And the good news, and this is, I guess, also the market consensus here, is that at this stage, it looks like there's a relatively low risk of turbulence from tapering. And indeed, our own economics team in the US would basically predict a very gradual path of tapering, which will basically mean that the balance sheet still expands for a considerable period of time. And they expect the first rate hikes indeed only in 2024. And the situation today is certainly very different from 2013 insofar as balance of payments are in much better shape. This is basically what macroeconomic models like this simple one will be picking up. But I think what they don't pick up is, I think, particularly the vulnerability to social and political shocks that I mentioned earlier. From a backdrop where the pandemic has further increased inequality, it has, in combination with the increase in global commodity prices, is now also leading to rising food prices. This is something that these models don't pick up, and it's something that may be actually a major reason for concern. If you just look at emerging market currencies in 2021, those that had the most significant underperformance all were hit by some sort of social or political shock of some kind. And we probably think that unfortunately more of that is likely to come. Moving on to the next slide, that shows the result of a regular vulnerability ranking exercise that we do for 70 global emerging and frontier markets, looking at as many as 5,000 variables to rank countries on their vulnerability that ranges from fiscal to the balance of payments, the credit sector, and so on. And and you can see that there is, even though my previous slide showed you there's a relatively low overall vulnerability of EM, there's a very significant divergence, of course, between countries. And there are particularly many so-called frontier markets, including those in including those in Africa, the Middle East, or also the Latin America and the Caribbean. There are major vulnerabilities. And even among the big ones, which are those that are red in the chart, which we call the GEM 10, you have significant divergence. You have countries which are quite solid and likely to withstand volatility very well, like Russia or Mexico or China. And then we have those that we think are particularly vulnerable, which especially are Turkey and South Africa. So even while we could have a scenario where global emerging markets deal with the tapering process reasonably okay, and we avoid a global systemic shock, similar way as it happened in 2013, it is actually quite likely that we'll see major divergence and that some emerging markets will experience much greater pressure than others. Okay, and last slide again shows you the results of a modeling exercise that we do regularly, which which effectively underscores my earlier point that the vulnerabilities on the balance of payments today are lower than they were in 2013 for sure. This is global emerging market currency valuation model, similar to what the IMF would call the macroeconomic balance approach. We look basically at sustainable current account balances and compare them to where we are at the moment, and then from that back out the valuation of the exchange rates. And in 2013, this would have showed you enormous overvaluations of most of the emerging market currencies. Well, in this case here, this stage, we think that Turkey and Argentina are really special cases. And unfortunately, these countries sort of gradually fall more and more behind the mainstream EMs in many ways. But the rest of the bigger EMs all look undervalued, and in many cases actually very significantly so. So this, we think, does create some buffers. It means that the dependence on external financing is much lower than it was 2013. But again, it doesn't focus on some of the political risks that I alluded to earlier. And it also doesn't focus on some of the fiscal risks that are probably at this stage actually more of the Achilles heel of EM than the balance of payments was in 2013. I'll leave it there, passing back to our host. Thank you.
Thank you very much, David. Now, our last speaker, Paul Gruenwald. Paul is the Global Chief Economist of the Standard & Poor's Global Rating. He leads the economic research agenda, of course, and previously he worked for 16 years or something like that at the IMF with dedicated to basically to Asia, if I understand, and China division and so on. So, Paul, please go ahead.
Great. Thanks very much, Jose. And hello, everyone from Lower Manhattan, not Cusco. I think we can agree Cusco would be optimal, but it's not going to happen this year. Let me start on behalf of S&P Global by thanking the organizers, the Central Bank of Peru, Inter-American Development Bank, and then Marc Uzan and the Reinventing Bretton Woods Committee. I'm gonna stick more to the macro credits. Just a little bit of a reminder, I work in the ratings part of S&P Global, and my team of economists is outnumbered 100 to 1 by rating analysts. So I'm gonna try to weave the macro and the credits together. I'm not gonna talk about ratings for compliance reasons, so we'll be talking about credit, which is a slightly more broader concept. First of all, going last has advantages and disadvantages. The advantages, I know what everyone is going to say, so I can taper my remarks accordingly. And the disadvantage, rather obviously, is that a lot of good stuff has been said already. I agree with almost everything my four distinguished colleagues said before. So I'll try to keep my remarks to 3 issues. 1 we've covered already, and 2 maybe not so much. So I will talk about the uneven recovery, basically developed markets versus emerging markets. Second, I'm going to dive a bit deeper on the sectoral. Felipe touched on that, but we spend a lot of time with my team and my credit colleagues talking about that. So I'll talk a bit more on the sectoral. And then on policy, I want to look beyond tapering and actually talk about the longer term size of central bank balance sheets and what that means for yields and what that, or how that feeds into macro credit. So let me take those in order. Like other speakers, we see vaccination differences as a key driver in the global growth differentials right now. We know that developed markets are generally ahead of emerging markets, and we've seen this wedge between GDP growth in the advanced countries and the emerging markets. The US in particular is getting a bit ahead of the rest of the world, which is good for the US, but this creates some unique problems for emerging markets. Barry touched on some of these, so let me go down my list here. First, obviously, if the US Fed moves first off of the effective lower bound and US rates start to rise, that hits countries that borrow in US dollars. There's also a capital flow angle to the extent capital flows are chasing returns and chasing growth rates, which is what the literature tends to suggest. We could see an outperforming US drive capital to the US and away from emerging markets, and that obviously feeds into financing. Stronger dollar, if that happens, would mean weaker exchange rates for emerging markets, and that's potentially inflationary. And then we talked a little bit about R minus G dynamics as well. So emerging markets in a way, and this doesn't apply to all of them, but I think a reasonably large subset of emerging market, it's not just a single whammy or a double whammy, it's actually a multiple whammy. It's slower vaccine rollouts, it's potentially higher rates, both for the US and domestically. We've seen some major central banks raise rates already, capital flows, etc. So, we're looking for an orderly reflation from both the macro variables and the credit variables. But if one major country, the US in particular, gets too far ahead of the rest of the world, that can actually cause some problems in and of itself. So that's a risk that we're monitoring. Let me go to the sectoral as well. Again, Felipe touched on this very briefly, but the same sorts of divergences we're seeing across countries, we're seeing those across sectors. And again, we pay a lot of attention to sectors with our credit colleagues. And I just wanted to make a comment first about this cycle. I mean, usually when we have a financial cycle, we have a boom and we have credit excesses, and those excesses have to be worked off, and there's a period of slow growth. Sometimes it's got a financial cycle or financial crisis with it, and then we recover as balance sheets are cleansed, and then we build to the next boom phase. That's not what's happening right now, because what happened last year, as we all know, because of the pandemic, certain sectors of the economies were essentially turned off. And we know which ones those are. Those are the sectors that have got the highest person-to-person contact, and they were shut off to mitigate the spread of COVID-19. So if we look across the sectors, we see things like food and beverage, leisure, airlines, travel, etc. Those were the sectors that took the biggest hits in terms of output, in terms of employment, and in terms of earnings. So as we recover from COVID and as we open up and interest rates begin to rise, financing costs begin to rise, the sectoral composition of the recovery is important. We've had some sectors that have benefited from the COVID regime. That would be sort of, healthcare and online shopping and others. And then we have the lagging sectors. But as we build through the recovery, we would expect and hope those differences to narrow. If sectors are left behind and got weak earnings, they're going to get hit on their credit metrics as the world economy recovers. So that's something that we're watching as well. And again, the sort of the baseline scenario is we've got an orderly reflation, and that is not just headline inflation. That's also some of the nominal variables we look at on the credit side, particularly earnings, and we look at earnings interest coverage ratios, etc. Last, let me talk about a bit about monetary policy. I agree with what was said about QE, and I think we would be in the I don't know what Barry called it, the cautious inflation, temporary inflation camp. We think temporary is being redefined to be a little bit bigger and a little bit longer, but we don't really see the full cycle of inflation pressures from input prices to output prices to wages. We really haven't seen too much at the macro level for wages. We've seen some sectors, but we do think this is going to be largely temporary, and we don't expect the Fed to move too much earlier. But I don't want to talk about tapering, and I don't really want to talk about policy rate normalization as well. I want to focus on the size of central bank balance sheets, because this really hasn't been discussed too much. Maybe it will be discussed at Jackson Hole next month, but we're talking about tapering, which is obviously the asset purchases of central banks. So that's the flow. We're talking about when central banks may lift off of effective zero and what the neutral policy rate would be. And that comes next in the sequence. But we haven't heard too much about the ultimate size of balance sheets. And that matters because that's holding the risk-free interest rate, which is the treasuries in the case of the US, and various instruments in terms of Europe down. That's holding the whole credit curve down. And that has implications for which firms are able to operate, even which firms are able to survive. We don't like to use the term zombies in my firm, but there are firms with relatively weak earnings and relatively weak business models that are able to survive in an era of ultra low interest rates that could not necessarily survive if we had a historically more normal level of rates. So as we go through tapering, as we go through rate normalization, the amount of assets central banks will be holding on their balance sheet, or extra assets that correspond to QE, that's going to be pushing rates down and the whole rate structure down. So as we come out of COVID, we'll be looking to see, what does credit quality look across the spectrum of sectors I've been talking about. And this also feeds back into, I would say, productivity and potential GDP growth if we go up to the macro level, because if we have marginal firms, low productivity firms that are able to survive in a low interest rate environment, then that's going to have longer implications and could feed into lower for longer and some of the things we've been talking about for the last decade or more. So just to sum up, I think we are very much in line with other speakers on the uneven recovery and the importance of vaccination and the need to make the recovery as orderly as possible, not just from a macro perspective, but from a credit perspective. We would, say, in addition to the country level, definitely focus on the sectoral level as well. And depending on the economy, those individual sectors may have relatively more or less importance, but certainly that level should be looked at as well. And then on monetary policy, we agree with the risks around tapering and eventual liftoff, but we've got the other largely unanswered issue still with us, which is what's the ultimate size of central bank balance sheets? How much government debt are they going to be holding? Are they going to be restricting the free float out in the market? And what does that mean for rates, firm survival, productivity, and ultimately potential GDP growth? So thanks very much for your attention, and José, back to you.
Thank you very much, Paul. So we have around 25 minutes for questions or for comments. I don't see at this time questions in the chat. I remind you that those who have comment or questions should send it through the chat, and I will pass it to the speakers. So before we start to receive a question or comments, I would like to move to a specific point. Several of the speakers talk about the B recovery, and that is correct. Many countries, many emerging economies will reach the level of 2019, the level of GDP of 2019 this year. Will recover after the strong fall into 2020. So it has a recovery, a strong fall and a recovery in 2021. And Professor Eichengreen talked about the importance of in order to fiscal, to debt sustainability, the importance of a higher, you name it, serious economic growth. So I think that the big question is about how is going to be the path, the trend after reaching the level of 2019. Are we going to return to the previous path? It seems, for example, as I said at the introduction, that the US probably will reach very soon the level of the previous path. But I have serious doubts that many emerging economies, and I am of course thinking in Latin America, will have difficulties to go to a previous path. And the previous path was not very steep path. We were growing at a low rate, a relatively low rate since 2014 in many of our countries. But even that, we may have some difficulties even to reach that path. So I would like to, and there are, I think, many reasons for not being very positive about the return to that path. I would like to start with Professor Eichengreen for comments about this subject.
So I think a starting point for thinking about these issues is the external environment that Latin American countries will face going forward. There are many scenarios out there. There are many scenarios for the US economy, for example, on the fiscal side. But on current law, there is going to be a very large negative fiscal impulse coming in 2022 as the budget deficits that we've been running in the United States are curtailed. China is moving in a more cautious direction in terms of policy support for economic growth. So it's not clear to me that the external environment for growth in Latin America will be favorable. Will Latin American countries be able to generate the demand internally for increased production? As I said in my earlier presentation, a lot has been done admirably on the fiscal and monetary fronts within the region, but that going forward is going to constrain how much demand support from the public sector can continue. So if I see a number of reasons to be cautious, skeptical, worried about the growth prospects of the region going forward, I welcome a more optimistic view from other members of the panel.
Okay, thank you. Ilan, Goldfajn, want to make a comment?
Yeah, I don't see, I agree with Barry that I cannot see a domestic factor for recovery stronger than we had before. I think fiscal space, monetary space at the best has been either used or at closer to the limit. As I mentioned in my presentation, I do believe that fiscally, a lot of the countries are either neutral or much more indebted than they were before, so you cannot get there. As some of you showed in the graph, interest rates are going up domestically, so it's not going to come from domestic front, and we are still going to face uncertainty coming from social issues, political issues, elections, and all of that. So the key, and has been the key, is the global scenario. Here, I mean, you can take the view on fiscal and monetary, whether you're going to have stimulus or not. But in general, Latin American economies depend on some of them, not Mexico has much, but the rest is a commodity boom. So the question is, are we going to see commodities continuing to go up? And the big question is, are we in front of a commodity super cycle? Nobody knows. Are we in 2003? I'm going to have 10 years into 2013. My answer, no. My answer, commodity has gone up. This is basically a cyclical recovery. And if you think that this will continue for the next 9 years, it's I don't see any reason for that. I cannot see the Asia growth conducive to the commodity boom of the products we see here in a longer term, as it was at that time. And I see the commodity boom as basically a sign of the asymmetric recovery, the need for commodities more in the very short term. So Concluding, I don't see major domestic factors. And unfortunately, I cannot see a global benign environment that has been up to now, continuing, for example, from 2022 on.
Okay, thank you. We have a question here in the chat from Gerardo Zúñiga. What are the factors that you will be looking at to gauge whether inflation will be more persistent? Wages, commodity prices? I think that this question go initially to David Hauner, who talk about this specifically about this point of more permanent inflation in the US. So I asked the question to David, and of course, if any other of the speakers want to make comments, welcome.
Yes, thank you. So indeed, it's it's first commodity prices, and actually, as a segue from the last comments, so we do think that the commodity super cycle is likely to play out. That doesn't mean necessarily that prices will keep going up for a decade, but they are likely to remain elevated for a decade, and we think that we'll see further upside over the course of the cycle. So we see, for example, Brent oil prices going above 100 again, and we think that copper prices will go to still do 15,000 in this cycle. And the reason is basically that a major period of underinvestment is now resulting in supply shortages, particularly in sectors which are in great demand when it comes to the green energy revolution globally, where we think that when you do forecasts commodity by commodity, there's a whole lot of them, particularly in the metal space, where we have major shortages. And ironically, we will also have, in the transition towards decarbonized economy, you actually have shortages, or at least low supply of crude oil, because at this stage is the lowest capital expenditure going into the sector in decades. So we think that that OPEC Plus will be very gradual in releasing supply, and that will keep prices relatively elevated. And towards the end of the cycle, it is likely that we have prices above 100 again, which will likely lift also global food prices, which are very correlated with energy prices, as we know. So I think this is clearly one key factor that will be making inflation more stickier. Secondly, it's wages, where we have a divergence. A number of sectors face significant shortages of workers, others don't. But we're also moving out, when you look beyond COVID, we are moving out of a period where we had, of course, over the last 30 years, an enormous release of a labor reserve, basically, into the global economy, which is now coming to an end because the regions which have been integrated into the global labor supply, first of all, are now experiencing themselves declining labor supply. And secondly, the whole issue of diverging systems, deglobalization, and so on and so forth, will basically, in our opinion, lead to higher wage demands in the developed world as well. And the third thing is clearly inflation expectations. We are starting to see them move higher in a lot of countries. When you look at, for example, the 10-year break-even in the US Treasury market, which reflects basically inflation expectations of the market, it has gone up basically towards 2.8%, which is higher than it has been for a very long time. And then also many emerging markets, when you look at the inflation-linked bond markets there, you're starting to see similar phenomena. So that is starting to get likely to start to create a feedback effect, particularly whenever countries are actually finally getting out of the pandemic and workers feel that they have a higher ability to demand wage increases again. The bottom line is our tracker suggests essentially that it is true that a large part of the current inflation spike is indeed temporary, but we do think that there is a significant and growing permanent component, which basically means that inflation in the next several years will be higher than it was in the last cycle.
Thank you, David. Felipe Larraín has a comment about this. Mute.
Jota, yes, I had a comment to the previous to the previous question that you asked as well. I think in terms of this inflation, other than what David said, I would add the fact that some of these supply shocks may be a bit more permanent than not just so transitory. So what is transitory? What is more permanent? You know, if something goes beyond a year, you know, it's just not so transitory. So these supply shocks in terms of higher transportation costs, in terms of the lags in the production of chips, which are increasing prices all over, is also an issue to consider in the inflation front. On the growth perspectives, I would love to take Barry's challenge and be more optimistic, but I don't think there are many reasons to be very optimistic. I think the fiscal space, saying beyond 2021, going to 2022, the fiscal space has been considerably reduced in our region, in Latin America and in the emerging world. It is considerably strained. There are countries that have already been downgraded. Take for the case, José, Jota, your own country, Colombia, has been downgraded. Argentina has been downgraded, not just to frontier market, but in a standalone category. So I think there are serious concerns in terms of the ability to be, pushing forward aggressive fiscal packages. There will be a time for consolidation. There needs to start consolidation beyond the transitory effects and the transitory relief measures that have been no doubt necessary on this pandemic. I would also say that the labor market is one worry. I would, I said it, but I would repeat that, this V-shaped recovery is not happening in labor markets. We have a lot of informality. We have, employment levels recovering, only partially. And in some, if you just move forward, what are the prospects of recovering in pre-pandemic employment levels? You have to wait probably until 2022, end of 2022, 2023, depending on how growth goes. So I think that is another important cause for concern. I would also mention, Ilan slightly mentioned the issue, but we have political issues in the region, elections coming and lots of, political uncertainty that is also influencing. So I would say that's another issue for Latin America, which is important. And certainly in the chart of foreign exchange, undervaluation and overvaluation that David showed us, I think that how probably those political factors have not been considered. Thank you.
Thank you, Felipe. I have two questions here in the chat. The first one from Alberto Humala. If emerging markets are in a better position to face tapering, will large international investors behave differently? Are capital outflows avoidable? I don't know who will the speaker want to make a comment. Paul.
Yeah, thanks, Jose. Can I answer the previous question and then this one, because I raised my electric hand. I don't know if you saw it, but
okay,
yeah,
sorry.
Yeah, no worries. On Felipe's last point, which I think is important, he was talking about some of the credit downgrades and the rating downgrades. And, if the yield curve is very low and very flat, then the cost of getting downgraded for financing is not very large, right? Which goes to a comment I made earlier. As long as we're in a world where central banks are holding down not just the policy rate, but the entire yield curve and making it flatter, we're taking the credit discipline out of the market, right? So if ratings or any other credit metric is supposed to differentiate between credit quality, and that's supposed to turn into higher borrowing costs, that whole mechanism is dampened by the fact that the central banks are in the market. So that's something to think about again as we go forward. The question on tapering, I guess our view would be it depends more on what happens in the money centers and the folks who are in that ecosystem rather than the emerging markets themselves. And all of the speakers talked about that already. If the central banks are clearer now than they were in 2013 about what's going to trigger tapering, how the process is going to be unfolding, what their sort of internal models are in terms of reducing the pace of accommodation, then the whole thing is going to be relatively smooth. We don't know, markets can react violently to changes in news, and then you can get the flows away from EM. But I think, the Fed and the ECB, the Fed in particular, is super cognizant of what happened last time. So I think Chairman Powell and his team are being very meticulous about talking about tapering, laying the conditions for tapering. And we all know what the objective is. The question is whether they can deliver that in a way that doesn't have the volatility we had last time around. If we get the volatility, that's kind of unambiguously bad for EM.
Thank you. Ilan Goldfajn wants to talk.
Yeah, basically answer this question on whether emerging markets are more prepared for tapering this time around and raising rates by the Fed in the US. I do see current account deficits better. I do see some improvements. Some of the charts that Barry mentioned are correct. But in general, I feel that markets will react badly. Of course, the more expected it is, the more prepared it is, the best. But I cannot see capital not flowing away from emerging markets, partly because think about 2022, we have elections in Brazil. It's going to be, nobody will know what will happen. It's a polarized election. That's one politics in one country, but we have constitutional, the new constitution in Chile, we have in Colombia, and markets are stretched. It's not that the investor will look and say, well, I have a lot of, these prices are cheap and whatever happens in the US, it's fine. I'm ready here to absorb the losses. Markets are stretched. In my view, valuations are not low. So the way markets unfortunately behave is that they cannot lose relatively in the upside. So they look around and say, well, as far as interests are low globally, I will stay. I will ride the boom, but they're increasingly uncomfortable because prices are going up, sometimes at the peak, some places at the peak. And domestically, they are reading the newspapers and every day there's an issue. And if interests are not low anymore, there's going to be a capital outflows. That's my impression. Strong capital.
Okay, thank you. It's 10:15 Lima's time. The organizer told me that I have to be very strict with the time, and we should move to the next session. So there is a question in the chat, but we don't have time to do it. I am sorry. I would like to thank all the speakers and all the participants. I think this has been a very, very interesting, a very useful panel for all of us. So I pass the floor to, I think, to Mariela, I suppose. And thank you very much.
Thank you, Mr. Uribe, and thank you for all the panelists. We're going to take a break of 15 minutes. Well, a little less than 15 minutes. We'll see everyone at 10:30 Lima time, 11:30 Eastern Standard Time. Sorry for the confusion. Thank you, everyone.
Thank you.
Welcome back, everyone, to the conference. We will start the second session, the next global financial cycle and meaning for exchange rates and capital flows. We have the pleasure to have Mr. Manuel Ramos-Francia, Director of CEMLA, as the chair of this session. Mr. Ramos-Francia, the microphone is yours.
Thank you very much. So first of all, let me also thank Marc, Uzan, of course, President Julio Velarde and Mr. Parrado for inviting me to chair the session. This is my fourth time in this seminar, twice in Cusco and twice digitally. It's always a pleasure to be here. So we're going to have in this session 4 speakers, which I will introduce in a moment. But let me first very briefly set up the session. So and we've heard many of these things now in the last session, but I think it's important to put it in the context of the topics of the session itself. So since the outset of the pandemic, advanced economies have maintained a very accommodative monetary policy stance. That said, more recently, their monetary policy prospects have started to diverge somewhat, especially in the short and medium terms. Particularly, the US inflation outlook for the relevant horizon seems to be diverging those from the Eurozone and Japan. The economic recovery in emerging market economies has been plagued with uncertainties and has been quite heterogeneous. This has already been mentioned in the previous session. Vaccination programs are sluggishly moving, with some exceptions such as Chile, and policymakers are having to deal with reduced fiscal spaces. Now, the region's main central banks embarked on a wide range of monetary policy accommodation. In most cases, reference rates were reduced to historically low levels. Most central banks set up different facilities for the timely provision of liquidity, as well as for enabling the provision of credit in the economy. Particularly, collateral standards for repo operations were relaxed significantly in many dimensions, that is, maturity, valuation, and also the universe of assets that can be used as collateral. Some countries also put in place programs to facilitate lending using government guarantees, as well as an important degree of regulatory forbearance. Most important for this session, various central banks set up programs to purchase assets, that is APPs, public and or private. All in all, many central banks put in place an unprecedented degree of monetary accommodation. Now, currently, emerging markets in the region have undergone pandemic-related supply disruptions and other frictions, as most advanced economies have also had to, as well as a surge in pent-up demand. In many cases, inflation readings have increased significantly, possibly over and above levels due to base effects, and considering that the mentioned disruptions will eventually also work themselves off. In this context, it is worth mentioning that in these economies, firms tend to have higher pricing power, especially the non-tradable sector, that is services, which could lead to highly persistent core inflation. All in all, many central banks in the region have started to pivot in terms of monetary policy by raising rates or by communicating more hawkishly. What's more, some emerging markets, central banks could relatively soon need to recalibrate or even to withdraw gradually or otherwise some of their programs and facilities. Beyond the domestic challenges the region's central banks might face, there is a risk of higher US inflation, which could put pressure on local nominal interest rates and or exchange rates and consequently have relevant policy implications. Domestic and global factors could feed onto each other. It would be fair to say that currently markets are pricing in a bump in inflation. Looking at US interest rate and inflation swaps, all sorts of break-evens and so on, as well as long-term yields, inflation expectations in the long run seem to be well anchored. However, it is important to note that not everybody is of this opinion, that intense debates have taken place recently concerning the near-term US inflation outlook. Now, summing up, given domestic and global conditions, most of the region's central banks are pivoting. Indeed, due to a combination of domestic and global factors, it is possible that they will have to reduce considerably the degree of monetary accommodation. In many cases, domestic pressures on inflation have increased, whereas if interest rates in the US, for whatever reason, also increase from present levels, emerging market economies' exchange rates would come under pressure. Of course, the choice, timing, and sequence of use of the different instruments will be key. Now, how does all of this affect capital flows? Emerging markets' capital flows relative to GDP have been maintained compared to pre-GFC levels. Their pre-GFC, that is the global financial crisis trend, however, was substituted by a volatile dynamic. In Latin America, their level increased in 2010 relative to pre-GFC, and since then have maintained a volatile dynamic. A notable change has been a shift in their composition, as we all know, from banks to investment funds intermediation. I think a very interesting paper that has all of these elements is the very recent CGFS paper from the BIS that deals with capital flows. Now, changes in the inflation outlook of different economies will lead to shifts in interest rate differentials, and accordingly in the relative monetary stances of such economies, particularly with respect to the US. Simply put, this will lead to changes in exchange rates and relative asset prices, which could induce capital flows. All of this can be circumscribed or interpreted as a global monetary gain. The discussion about the determinants of capital flows are centered on push, pull, and pipes factors. This will affect the level and volatility of such flows. In most cases, attention has focused on push and pull factors. However, for EMEs, pipes factors can be quite relevant, given the characteristics of the financial markets and of the main players that participate in them. Now, let me talk very briefly about unconventional monetary policies. In the COVID-19 crisis, some central banks have decided to provide support by intervening in the long end of their domestic currency government yield curve. There are mainly three rationales for implementing APPs. The first one is to improve functioning of bond markets, the second to provide additional monetary stimulus to aggregate demand, and the third to ease public financing pressures. Of course, there are several ways to go about it. We consider first, central bank can offer interest rate swaps, for instance, fixed or floating. Second, central bank can also offer government bond swaps, that is, exchange government bonds with different maturities. Now, of course, the fiscal authority can also implement this interest rate and maturity transformation operation. Two key issues are then whose balance, that is, governments or the central banks will absorb potential ex-ante losses, or even perhaps expose profits, and two, which institution makes the appropriate provisions to back the facility or policy under consideration. Third, central banks can buy government bonds in the secondary market. In the case of EMEs in general, some central banks face restrictions on doing so. Fourth, the central bank could buy bonds directly in the primary market, which essentially means that it would be monetizing its fiscal deficit. I understand that so far only Indonesia, which is of course not in the region, has resorted to this. Fifth, the central bank could also buy corporate securities. Now, this brings to the table the complex issues of valuation, default risk, and the conditions for determining which corporate bonds would be eligible for purchase and which would be left out. Now, unconventional monetary policies have been used before in some EMEs, like offering investors interest rate or government security swaps. But this time around, it has been a little bit different, as some central banks have put in place APPs for public and or private assets, together with other measures that have meant, in many cases, an unprecedented degree of monetary accommodation. It would thus be important to evaluate if these programs are not stoking inflation, and if central banks decide to keep them permanently in their policy toolbox, whether they could lead to important increases in moral hazard on the part of their beneficiaries. All in all, most central banks, both globally and in the region, are pivoting to beginning to do so. However, looking at the US case, at present, markets are not foreseeing considerably tighter financial conditions, or in other advanced economies for that matter. Furthermore, it seems that at present, the consensus is that in advanced economies, the most pressing long-run problem will continue to be one of savings absorption, deriving in the continuance of low natural rates in most advanced economies. Nevertheless, central banks in the region have their work cut out, as most will have to pivot considerably more in light of significant increases in inflation readings. So today we have 4 speakers, and let me very briefly say a short bio concerning our first one, which is Luis Oganes. Now, Luis Oganes is a managing director and head of currencies, commodities, and emerging markets research at JP Morgan, which he joined in 1997, and has worked in New York and London. On several occasions, he has participated in advisory projects with governments and quasi-sovereign entities in Latin America, the Middle East, and Asia. Luis obtained his PhD in economics from NYU in 1998 and his BA in economics from Universidad de Lima. So, Luis, as our first speaker, you have the floor. Thank you very much. Go on, Luis.
Thank you so much, Manuel. Good morning, everyone. Marc, Julio, and Eric, thank you so much for once again inviting me to participate in this event. I hope that we can resume it in Cusco when conditions allow once again in the coming years. I want to show you some slides to try to illustrate some of the points that Manuel has just mentioned. And obviously, given that I think I'm the only participant in this panel coming from a financial institution, I wanted to focus a lot of my comments on how the market responded to what central banks across emerging markets did. The first slide, this chart clearly shows that EM central banks basically across the board slashed policy rates in response to the pandemic in 2020. They did it in many cases, bringing rates to the zero lower bound, especially the low yielders. Obviously, the high yielders had more room to cut, and they did so. So in many cases, they reach in terms of either nominal or real terms historical lows across countries. This, I have to say, when it started happening, when we were discussing this with investors, there was quite a bit of nervousness because it was unprecedented, the degree of monetary easing that was taking place at a time when, of course, there was a lot of uncertainty and there was concern, as usually happened in the past, that you could see with real rates turning either going to zero or negative in many countries, that this could spur massive currency weakness and stock inflation at the worst moment, given what was going on the real side of the economy because of the pandemic. That unfortunately did not happen. And this is basically because I think that probably there's something good to say about how emerging market central banks in the last couple of decades, by targeting inflation, have gained some credibility. And probably the market actually was able and willing to digest the policy response that in a way mimicked what developed market central banks had done, and didn't press the panic button. Moreover, those countries, either those that reached the zero lower bound or had reduced their policy rates in real terms close to zero, decided to pursue an extra step, once again mimicking developed market central banks. And you can see in this next slide, as Manuel had said, they resorted to the previous slide, please. They resorted to quantitative easing, and in many cases they were buying government bonds. In other cases, they were buying non-government bonds. But the magnitudes, were significant. We have almost 9% in the case of Philippines. Other places like Poland, Hungary, Israel, or Indonesia, somewhere between 4 and 6%, etc. The reason why central banks pursued this obviously was a way of controlling yield, a little bit yield volatility, given that many curves had steepened quite a bit, but also as a way to inject liquidity. We do think, however, that now that central banks have experimented with this new policy tool, it's probably going to remain as a permanent part of the arsenal, particularly whenever policy rates are brought very close to zero, to the zero lower bound, and when there's a need to pursue more monetary easing beyond that level. So the other reason why we think that probably we're going to see quantitative easing remaining for some time, even though at this stage, because of the inflation flare-up in many countries, QE programs have either been halted or just taken a pause, is the fact that the impact of the pandemic is probably going to keep fiscal deficits large for quite some time, forcing governments to keep issuing bonds. And therefore, there's going to be this element of yield curve control also embedded in this QE program. So probably more to come on this. It is unlikely that these QE programs are going to be fully unwound, because again, governments are going to need this kind of help from central banks trying to keep the lower end of their yield curves under some kind of control. We go to the next slide. We can see what was the reaction of the market. So on the left-hand side, you see the red line, if you can distinguish it from all the lines there. That was the response on average of emerging market currencies to the pandemic, and we can see that in comparison with other previous shocks, and we're including there, the global financial crisis, the taper tantrum, a couple of oil crashes in 2014, 2015, also the Eurozone peripheral banking crisis, etc. So what we can see is that at the very beginning of the pandemic, when central banks started to slash policy rates and announce QE programs, of course, there was currency depreciation. The good news, though, is that because before this happened, inflation was probably in many countries, if not most, coming below the midpoint of their inflation targets. They did have room and tolerance to allow for the currency to do part of the adjustment, right? That is the merit of having a flexible exchange rate. Whenever you get hit by a shock, that it is, in this case, external or global, you let the currency, absorb, act as a shock absorber to the real economy, and therefore a part of the optimal policy response is actually to let the currency weaken. That said, even though it happened in the same magnitude in the first few weeks, maybe up to week 30 or 40, between 30 and 45th week, post the initiation of the pandemic, sometime in late February, early March, we started to see, the EM currencies stabilizing and actually appreciating a bit, coming into the early part of this year, or in the second quarter of the year, and so in terms of magnitude, then that currency depreciation did follow the pattern of the global financial crisis. However, since then it started to deviate. The global financial crisis, we did see much more currency depreciation. Same thing, for that matter, for the taper tantrum and other previous shocks. When we see what the reaction was in rates markets, beginning a little bit of the same thing, right? So to the extent that EM central banks slash policy rates, obviously market rates also came down. And so at some point, actually, market rates in emerging markets outperform U.S. Treasuries. However, as Manuel also mentioned, there's still no guidance from the Fed about tightening monetary policy, beyond just talking about tapering. However, because EM central banks have not waited for the Fed to start acting, to start, in some cases, hiking policy rates, and this is because of an inflation uptick that many countries are experiencing, we started to see in the very latest few weeks that EM rates are underperforming treasuries. But again, this is because of the policy response of central banks. If we go to the next slide, we can see that central banks, again, have started to hike interest rates, again, not waiting for the Fed this time around. This is something that also markets are seeing with positive eyes, let's say. Why so? Because in the past, oftentimes, EM central banks ended up hiking rates whenever markets pushed them to do so. And this was because the currencies were under excessive currency depreciation pressure, or inflation expectations started to get de-anchored, etc. This time around, in line with their their own inflation targeting mandates, and given what they are seeing in their own Taylor rule dynamics, EM central banks are following the script, and they're deciding to hike, even though the Fed, again, keeps saying, or developed market central banks are still keeping monetary policy quite expansionary. In this chart, what we have is the light blue line is the change in the policy rates from the lowest point in 2020 up until now. And what we can see stacked above them in the dark blue bars is what we expect the tightening to be, the hikes in policy rates between now and the end of 2022. So again, we have quite a bit of hikes, obviously more so in the high yielders than in the low yielders. But again, this is something that is in reaction to the fact that, well, obviously there is economic recovery to speak of, as we emerge from the pandemic lockdowns, and there is, some inflation pressures that are accumulating. Now we can debate, and this is not, I think, the purpose of this panel, to debate how temporary or permanent, these inflation pressures are. But to the extent that the inflation pressures, the ones that are present or that we expect to come, are already generating some pressure on inflation expectations, central banks across EM are coming under pressure to tighten, and this is what we expect to happen in the next year and a half. If we go to the next slide, once again, we can compare here our own forecast of how much tightening we expect across the EM and what the market is pricing. And you can see on the right-hand side, just the red bars. In most countries, the market is actually pricing more than what we are forecasting for hikes. And you can see probably the extremes are in Colombia, in Turkey, followed by Hungary, maybe Malaysia, South Africa as well. Again, it is possible that we're wrong, that we're going to need to chase and keep adding hikes to our own forecasts. or, as usual, there's also the possibility of markets overreacting and pricing more hikes than what is warranted. Time will tell. The fact that we have seen, a further decline in U.S. Treasury rates, maybe at the margin, that reduces some of the pressure of EM central banks to hike. But again, they're doing so because of their domestic inflation dynamics. They're not hiking because the Fed is signaling hikes itself. So there is so much cue that local rates are taking from treasury rates these days. So they seem to be not necessarily decoupled, but following individual country stories, and this is a result of that. If we go to the next slide, then we can conclude with what has been happening with capital flows. So once again, you can see on the left-hand side the pattern of capital flows. And these, by the way, these capital flow numbers are portfolio flows. And we distinguish, we aggregate in the portfolio flows what we call retail money. So it's retail inflows, money that developed market investors put in emerging market dedicated funds, and also some of what we call real money or strategic allocations, which is institutional money that also gets deposited in emerging market dedicated funds. So this is not the same. I know that Elena probably is going to present some different numbers that the IIF tracks that does include FDI. These numbers are just portfolio flows. They do not include foreign direct investment. What we can see here is that the initial reaction of capital flows did mimic as well what we saw with the global financial crisis, which is a decline. However, at some point, after just a few weeks, actually, we started to see some stabilization despite all these cuts and QE programs that were announced, and capital flows started to stabilize, and it started to actually recover. And if you see, these numbers are cumulative. So if you see that where we started at the beginning of March, when the pandemic started, and where we ended the year, 40 weeks or so later, basically by December, all the declining capital flows have been fully reversed, which is rather remarkable in a year so complicated as was 2020 because of the pandemic. So basically, by the end of the year, we had fully recovered from all the capital outflows that we saw in the early part of the pandemic. We got a chart and we tried to say, okay, identify which portion of the capital flows of these portfolio flows were the ones that recovered. We can see clearly two components. The hard currency capital flows going into hard currency bonds, meaning that the bonds that emerging market issuers, be it sovereign or corporates, issue in hard currency. There is no currency depreciation risk embedded in these bonds, and that is where we saw massive appeal, and of course the search for yields is still there, and that's why every time that any issuer started to come to market with hard currency debt, most of these issues were heavily oversubscribed. We also saw quite a bit of inflows into China dedicated funds, and you can see that the blue line on the right hand side as well. Again, China opened its capital markets to foreign investors. It is a massive bond market. Investors by definition are underinvested because this process only started a few years ago. So there's been quite a bit, and the yuan actually, if you recall, in the early part of the pandemic actually appreciated. So there was actually the appeal of a stable or appreciating currency, plus at least some carry to earn in these bonds, and we saw massive allocations into Chinese bonds. The part that did not attract capital flows and that remains actually 10.5 billion below the initial point of the pandemic, basically of outflows, is local markets, local currency bonds. So that is where a lot of the impact of currency depreciation is concentrated. That is a lot of the concerns of central banks hiking policy rates is concentrated. So I think that possibly when the policy tightening cycle that I showed you in previous slides is a little bit more mature, and once we get some currency stability, we may see money coming back into local markets. But for the time being, hard currency is the place to be, So, big, as a conclusion, I think that this has been a very important experiment in EM central banking that I would say that overall has added to more tools to the toolkit, which is a positive, giving EM central banks more degrees of freedom to react to shocks in the future. Markets, interestingly enough, did not panic when they adopted them, and we have seen capital flows resuming and recovering from the initial shock, which is also good news. Going forward, obviously, time will tell, what happens when actually the Fed starts hiking. That is probably the biggest cloud in the horizon. But as Manuel said at the beginning, the expectation is that, it probably won't happen yet in 2022. Maybe 2023 will be a different story. We may see once again pressure going down of outflows for both hard currency and local currency bonds. But for the time being, again, hard currency debt, you try to issue it, there's a willing market willing to buy those bonds and absorb it. So that was the message I wanted to leave here. Thanks, Manuel. Manuel, I think you're in mute.
Thank you very much. Thank you very much, Luis. We're going to have a little change in the order of the presentations, given that Giovanni Dell'Erici has been having problems with his internet connection. So let me introduce him very briefly. Now, Giovanni Dell'Erici has worked in the Asia and Pacific Department at the IMF. His research interests include banking, the macroeconomics of credit, monetary policy, international finance, and conditionality in international lending and aid programs. He is a CEPR research fellow. He holds a PhD in economics from MIT and a bachelor's from the University of Rome, La Sapienza. Of course, now he's the deputy director of the research department at the IMF. Giovanni, it's a pleasure. You have 10 minutes to present. Thank you.
Yeah, and thank you for the flexibility with the order. My internet connection here is very unstable through my phone, and I hope you can hear me. You can hear me well.
We can hear you now. Thank you.
Yeah, let me share my screen, and a lot of what I'm gonna say is gonna echo what both Manuel and Luis said in their interventions, and a lot of what I heard in the previous session. There is a I hope we are all right rather than being all wrong here, and that there seems to be a lot of group thinking on what's going on, and even the degree of uncertainty, I would say, as a personal note, is a little bit worrisome. So just for the legal aspect, the views expressed in this presentation are my own and do not necessarily reflect those of the fund. So let me see if I can make the slides. Let me start with going back about a year. And so a year ago, there was at the beginning of the crisis a very sharp contraction in financial conditions in emerging markets. But this was almost immediately met by very significant easing in core countries, in advanced economies, both in terms of cutting policy rates where there was room, and in resuming very aggressively asset purchase programs. In the bottom chart here, you can see what the Fed and the ECB did. In the top chart, you see the MB spread and how it shot up, but then it calmed down relatively quickly. Now, something very different that happened from previous episodes was that central banks in most emerging markets were able to act counter-cyclically, and they were able, as Luis just showed you, here is more a 30,000 feet picture, to cut policy rates quite aggressively in many cases. And at first, in many countries, they launched their own asset purchase programs. And as Luis pointed out, these were the motivations were a mix of market stabilization, monetary policy, and in a few cases, fiscal support. So where are we now? Well, now the way we see it is that overall the GDP outlook has improved, in particular for 2022, but at the same time has become more asymmetric. And So there has been a major evaluation of GDP growth in advanced economies, much less so in emerging markets. You see the growth revisions for the WIO here in the middle chart. And of course, the risks are obvious. There are new variants, very uneven access to vaccine and vaccination programs that are at a very different spots. And at the same time, the risk that financial conditions in advanced economies could tighten quickly if inflation ends up being higher than what is expected. I'll discuss the policies at the very end. So this is just to give you a picture. We've been talking about finance. This is about the pandemic, which has an immediate impact on growth prospects. And you see how the pandemic, especially in the past few months, has been evolving in a very asymmetric way, with the cases and in particular hospitalizations and deaths contracting sharply in advanced economies and much less elsewhere. The Delta variant in this past couple of weeks is leading to a resurgence of cases in advanced economies, but still with very few deaths and hospitalizations. And this is purely a reflection of the vaccination programs that you see in the middle, and vaccination programs that have been very effective, in particular at controlling the most severe cases. At the same time, we're seeing a resurgence of inflation like we had not seen in many, many years. If I remember correctly, about 2/5 of the countries in our samples are in the top quartile of inflation rates, and this had not happened since I think 2012 or 2013. And this has been almost across the board. Has been very notable in the United States, but we've seen it in many countries. And this has been also accompanied by a recovery in commodity prices. Now, our commodity unit is estimating that commodity prices may be peaking, but again, the trends are very visible. So is this inflation? It is, I think, is the $1 million question. And is inflation here to stay? Is this a blip of a few months? There are some reassuring signs, but there is a lot of uncertainty. The reassuring signs are, one element that we've seen is that if you compare good inflation versus services inflation, it's quite in an unusual spot. And in most countries, in general, these two go together, or service inflation tends to be higher. And instead, we are seeing exactly the opposite. This is to a large extent the results of bottlenecks and disruptions in the supply chain. At the same time, inflation expectations have remained very well anchored with very little movement in the past few months, even in the face of quite sharp inflation surprises. So now looking a little bit, trying to predict how big a problem for emerging market a tightening cycle in advanced economies could be. In a recent WIO chapter, a team estimated essentially, you can think about it as the pass-through, the spillovers from monetary policy in the US and in the Euro area onto government bond yields in emerging markets. You can see that the ECB has very limited impact in the top chart here. The columns that are not shaded are non-significant coefficients. And in general, the European Central Bank has a direct impact for Eastern European countries outside the Euro area, but not much else. But the Fed clearly has a large impact. And you can also see on the benefit side, in the bottom chart, the lower yields that the interest rate cuts by the Federal Reserve and purchase programs helped dramatically emerging markets at the beginning of the crisis. Now, there is also quite a degree of heterogeneity in this impact across different emerging markets. And this is not going to be a surprise, but countries where, for example, they are speculative grade in credit, they have high external debt, they have high currency volatility, tend to have to suffer from greater spillovers during a tightening. There is also some evidence that these coefficients are changing over time. They were much larger during the GFC. They are now larger than they were before 2008, but they have come down quite a bit. So as a final example, I think that the inflation surprise, and this is the Citibank index, inflation surprises clearly showed the potential impact of tightening. And we have seen in February and March a dramatic reduction in portfolio flows to emerging markets as a result of the concern that the Fed would start tightening. Then Fed communication was very effective in calming markets, and things are normalized a bit, but nevertheless, the flows remain below what they were before. And more in general, and this is maybe a more in detail a picture that Luis showed you, is that local currency bond flows to emerging markets, with the exception of China, remain well below pre-COVID. And even within Latin America, there is substantial heterogeneity across countries in where these capital flows are. But overall, and this is the last chart to the right, you can see the share of non-resident holdings in these markets remain very subdued relative to normal. So in conclusion, so that I can stay within my time, there are a few maybe wishful thinking policy prescriptions that would help. Well, first, and I think I want to say first and foremost, international cooperation in reducing vaccine inequity would help closing the fault lines in terms of growth prospects. Now, this is more easily said than done, but it's clearly something that should be at the forefront of international policymaking. The way, in terms of what advanced economy central banks can do, I mean, of course, they have their own mandates. And if inflation had proved to be more persistent, they would have to enter a tightening cycle earlier than expected. But I think that doing that in an orderly way with clear communication and early communication so that markets would not be spooked would help emerging markets in a major way. I think on the emerging market side, because of the more vulnerable fiscal position, it would be very important to communicate very clear medium and long-term plans on the fiscal front so that they could maintain a certain amount of credibility on the monetary policy front, because I think here the specter is always fiscal dominance, especially so the way we have seen emerging markets entering in unconventional monetary policy. It was terrific because markets did not interpret that as an episode of fiscal dominance. Inflation remained subdued, inflation expectations remain under control, but the longer this goes and the more fiscal comes under pressure, the greater is going to be the risk of markets interpreting monetary policy moves with a fiscal flavor. And I'll stop here. Thank you.
Thank you very much, Giovanni. It was a very nice presentation. Let me now, before I turn the word to our next panelist, let me just say, if you have questions for the panelists, please send them to my chat or to the chat. And then when all panelists are done, we'll take a look at those questions. And for the panelists, you'll just have to raise your hand, the raising hand option, if you have any questions for any other panelists. So let me go on to the third speaker now. She is Elena Rabikova. Hold on a minute. Elena directs the IIF's economic research on emerging markets. She was previously a visiting fellow at Bruegel, where her research focused on financial markets, EMs, and central banks. Now, prior to Bruegel, she held senior level roles in economic research at a diverse set of financial institutions, most recently with Deutsche Bank in London as head of the EEMEA research, as well as leadership positions at Amundi, which is Pioneer Asset Management, Avantium Investment Management, and Citigroup. She's also taught graduate and undergraduate courses at the Stockholm School of Economics and given guest lectures at LSE, New Economic School in Moscow, and Chicago, both in London. Elena began her career as an economist at IMF headquarters in Washington. It's a pleasure to have you here today, Elena, so you have the floor. Thank you.
Thank you so much, and it's an honor to be here. It's the second time, and I hope next time we'll be in Cusco indeed. And it's fantastic to be with my former colleagues and friends here today. Thank you. I will try to share the slides. I hope it works, but if it, oh, I think we're fine, right? You can see the slides. So, as Giovanni said, we do have a lot of groupthink here. So I do want to just highlight a few things that maybe were not raised as much before. And I think the first one is, as you can see also on these slides, is we have exceptional core movement and inflation. And it's not just has to do something with the commodity prices, but it's just sort of a phenomena that were noticed much more in the developed markets before. And some of my colleagues, including Kristen Forbes, has been writing about it, but increasingly more in emerging markets as well, even before the most recent shock. And we see that in headline inflation, we see that in core inflation, and it's sort of like the lower inflation globally and increasingly core movement in inflation. And this is something atypical for emerging markets, because it used to be that our emerging markets have the more sort of independent sort of country-specific crisis and risks, while here it seems to be the sort of empirically the picture that there is much more core movement and sort of lower inflation. And again, the current shock, we have it updated also for headline inflation. The shock to headline is much lower than we saw in 2009, the pickup in headline inflation as well. So I think that is one phenomenon that we do need to keep in mind. And why is because for central bankers in emerging markets now, it's important to understand what proportion of inflation actually we're controlling, because in theory, it should be much more local phenomenon. It should be sort of something related to the domestic output gap or domestic demand conditions, and a little bit of the spillover from the global commodity prices or pass through from the exchange rate. So that's something that the fact that there is maybe a co-movement, some global factor that we're not quite controlling from the domestic economic conditions, I think that's something that we need to be mindful and probably invest more time into studying. So if you go to the next slide and we'll look quickly at the inflation expectations, that sort of we talked a little bit now about the shock to the inflation expectations because of the crisis, because of the commodity prices. Again, it's very different from what we saw in the previous crisis. And here in the middle, we see inflation expectations pick up in 2009 versus 2020. And again, it's much less pronounced, and it probably has something to do with the credibility of the emerging market central banks and the fact that we're moving away from just an emerging market central bank, something more to the developed markets from the perspective of inflation targeting. And going to the next slide on the left, my traffic light chart on the left, you see that first of all, the sheer number of the inflation targeting central banks in EM has increased dramatically. This is from 2000 till 2020. And also the number of central banks that are above target, the red of the traffic light, is also much lower. So, so we have a situation where maybe inflation expectations are picking up, but the actual sort of inflation above target is actually not in so many countries that would seem to us. So just moving to the next slide, and here again, as I talked about co-movement in inflation and in emerging markets, it could be the commodities. And so we try to look, of course, we know that a range of commodities, not only energy prices, have increased significantly post recovery from the worst of the COVID shock. Of course, we're not fully recovered from COVID yet, indeed. We see that had an effect on headline inflation. But we're also a little bit struggling from identifying exactly sort of to what extent and the mechanisms. So one could say, look, we have a global pickup in commodity prices that feeds into shares of the imports, import prices, and that feeds into PPI and then the CPI. but it's sort of the numbers, the actual numbers of the feed through of this commodity prices shock to the headline, and especially core and emerging markets, is not as high as you would think from a lot of the traditionally estimated coefficients of what we have seen in the past. Nonetheless, as we talked a little bit earlier, you know, the core movement is sort of the principal component here. I'm just looking at the first principal component of the commodity prices and inflation in emerging markets. We don't see such a strong, we see a strong pickup in core movement, but we haven't managed yet to link it to the just only the commodity prices. So there is potentially something else, and it's at least definitely worth investing more time into research of that movement. So that said, we're talking, of course, about global financial stability and the QE. So how to what extent, you know, the inflation in EM matters for yields, right? For yields in local bonds. And we started talking about strong core movement and EM inflation. But of course, if you look at local bonds for EM, there is even higher core movement. And not surprisingly, it tends to pick up when you're having a global shock. So again, here on the right-hand side of the chart, you see the principal component of the local EM bonds yields, again, is picking up sharply whenever we tend to have a global shock. Again, it's not entirely surprising. My colleagues talked about high share of foreign investor participation in local bond market. But again, it's important to understand for our policy making that, you know, the transmission from our policy rates into the financial conditions in the country is not perfect. And that is also why we saw the pickup in the QE programs. And that's why also the QE programs are likely here to stay, because it's something that it helps to smoothen or to improve transmission mechanism of the monetary policy to the local bonds. And then the final comment I wanted to make is something about credit versus local bonds. So if you look at the credit or so-called borrowing and foreign exchange or a Eurobond market for emerging markets, and also Giovanni just talked a little bit about it, and Luis as well. It's interesting that in the blue, we see there in the middle, the fact that this credit, the spreads of this sovereign bonds for emerging markets haven't reacted as sharply to what seems to be the sort of traditionally global factors of instability. You know, we have the volatility index here, VIX, we have the US rate, we have commodity index, you know, so commodity index had a big impact, you know, we have economic surprises there. It seems that maybe positive economic surprises had a positive or sort of a narrowing of the spread for emerging markets. It's very different from the picture to the right, where here we're comparing it to the taper tantrum, where volatility index had a very strong effect on the credit spreads. So this is looking at the period from early in the year till now, and then comparing it to the taper tantrum. So what I'm trying to say here is that our credit market seems to have graduated a little bit more from being an emerging market, purely emerging market instrument. So the credit seems to be sort of more independent from this global spillovers than we have seen in the past. If there could be sort of a false sense of security where maybe current accounts were in a much better condition, not because of a particularly good thing, but also just mostly because of the lockdowns and the fact that we have contracted imports significantly. So the majority of emerging markets had a current account even surpluses because of COVID. And maybe that's why credit hasn't reacted so much on the global conditions. But it also has maybe possibly something to do with emerging markets beginning to graduate and becoming sort of a bit more integrated and less vulnerable to the swings in the global conditions. So this is on the credit. On the local market side, what we see is that, again, inflation maybe is much more coordinated, and we need to investigate more to what extent domestic factors versus global factors, and what kind of global factors are affecting our domestic inflation, and therefore our policy making in our monetary policy making. Second is that we have much more co-movement in local bonds, and of course QE can help us improve the transmission mechanism. But of course, the best case scenario would be to have deep domestic financial markets. And of course, you know, South Africa can run a government debt to GDP ratio of almost 100%, partially because their domestic financial system is more than 200% of their GDP. It's very different for some of the countries in Latin America or in Eastern Europe, where the depths of the financial institutions are much lower. We have about maybe 70%, or in some countries, even 11% of GDP, where of course the financing through these local bonds is much more difficult. then also the composition of the domestic financial markets matters. Actually, I'm going to stop sharing so we don't get distracted. The composition of the financial markets also matters, where you have maybe banks versus institutional investors in emerging markets. And in the country, of course, the debt helps of the banking system, but where you naturally have pension funds or insurance fund or maybe asset managers that are naturally interested in longer term instruments, again, it gives you much more of a buffer. And therefore there, maybe the need for QE is also much less from the central bank. The need for QE, for central bank to step in and smoothen out sort of this global shocks are also small. So just to sum up, we see the sort of emerging markets being sucked into this co-movement. Maybe 10 years ago, we noticed that for developed markets, but now increasingly also, we need to start thinking about that for emerging markets. We also see much more co-movement in the local bonds. We do need to invest more time into understanding the depths of the financial markets and what that means for our policy making locally. And then finally, to pay attention to credit, where we need to understand better whether indeed the global shocks are as damaging as we have seen in the past, and whether that's related just for this specific case of current account, disappearance of current account deficits, or maybe it's something that emerging markets are indeed graduating and becoming sort of less vulnerable to the sort of global instability as demonstrated by either VIX or the US dollar index. So that is it from me. Thank you so much.
Thank you very much, Elena. And now we're going to have our fourth speaker. Let me introduce him. He is Moritz Schullerich, who is a professor of economics at the University of Bonn and the director of the Macrofinance Lab in Bonn. He's an elected member of the Academy of Sciences of Berlin and a research professor at NYU. In 2015-16, he held the Alfred Grossa Chair at Sciences Po in Paris. Previously, he taught at the Free University of Berlin and was visiting professor at Cambridge. In 2018, he received the Gossen Prize of the German Economic Association that is awarded every year to honor a German-speaking economist whose work has gained international renown. He's a fellow of the Institute for New Economic Thinking and a managing editor of Europe's most important policy journal, Economic Policy, which is a joint initiative of Sciences Po, CEPR, and CES-IFO. His work on credit cycles, asset prices, and financial stability has provided the backdrop for potential policies aimed at curbing credit booms and stability risks. His research spans macro, finance, international economics, and economic history, and has been published in very prestigious journals. So, Professor Schullerich, it's a pleasure to have you here. Go ahead, please.
Thank you so much, Manuel. Thank you for the invitation. Thank you to the organizers. I'd love to be in Cusco. I've been before. It was a fantastic conference. Congratulations to the Central Bank of Peru and the Bretton Woods Committee for doing that so successfully by so many years. Let me also say I'm strictly speaking for myself and not for any of the organizations that I've been affiliated with over time. And I'm gonna zoom out because we've heard from such prominent and competent speakers about the situation in capital flows and the situation also in with regard to monetary policy per se. So I thought I'd pick up on one of the topics on the agenda, namely to talk a little bit about the challenges about in the coming years. For monetary policy. I think Giovanni mentioned it earlier that we all seem to be thinking very much alike about inflation and the success of the stabilization policy. So I thought I'd take some academic freedom and actually zoom out and ask about the reversal of the great moderation that is talked about in the agenda for today, whether we should fear that and what the challenges are going forward for monetary policy. And it happens to be the case that there have been shifts in monetary policy frameworks in history, and they have been very influential and very important. And I wouldn't, I'm speculating, obviously, as from an academic point of view, but I think we might be underestimating the challenges that central banks internationally, globally face in the next decade or so. And, maybe it wouldn't be surprising if in 10, 20 years, central bank mandates look very different from what we've been used to. I'm not saying that's a good thing or a bad thing. I'm just trying to put some thoughts together. There's three points, three reasons why I think the future could be very different, and the challenges go far beyond the reversal of the Great Moderation. And they have to do with three developments. The first one is that the framework that we used, all of us, to think about how monetary policy works and what its relationship is with the macroeconomy has undergone a very substantial, let's call it refurbishment in the past 5 to 10 years under the headline of the heterogeneous agent modeling of the economy. And with that modeling, I think there are changes in what central banks, what monetary policy does and how it's transmitted and how it works that are not deeply appreciated, but I think they're actually quite important. And as these models sort of translate from the arcane world of like very quantitative macro to the policy world, I think we will realize that there are substantial challenges. The first one is that the idea of divine coincidence that you have all been that we've all grown up with. So the idea that by stabilizing inflation, central banks stabilize output, that keeping inflation close to target was kind of all that was necessary to support the economy through the cycle, irrespective of the source of the shock, and that welfare losses will be zero and the economy attains its first best allocation. This idea is no longer there in Hank models. In Hank models, there were many missing parts in this old new Keynesian representative framework, but in these modern or like sort of next generation models of thinking about the macroeconomy, there are agents that differ. Some are rich, some are poor, some own a house, some don't, some have access to credit, others do not. Some are old, some are young, and some have high marginal propensities to consume and others don't. And I think that's a very realistic take on how the world works and how the world looks like. There are also incomplete markets, there's imperfect insurance, all of these things, different portfolios and borrowing constraints. And if you put all of these things together, divine coincidence no longer holds. Stabilizing inflation does no longer stabilize employment in the economy. It's because of incomplete markets, distributional concerns, normal rigidities, but divine coincidence. So this lovely dream world for central bankers where caring about inflation there was no trade-off, at least not a severe one, between that and employment. That certainty is gone. Then let me come to the second point, which is one that's very much debated recently, and that is the distributional angle of monetary policy. With the different agents that are around in these models comes a strong, we can discuss how strong, but it comes a distributional angle to what central banks do. So it's no longer true that we can proceed, or that, that's at least what recent research thinks, that one can proceed with the assumption that monetary policy is distributional neutral. And that is important because a lot of what central banks do these days work through channels that have to do with asset portfolios, very clearly in the case of quantitative easing and other asset purchase programs, but also in the case of other transactions with, changing interest rate, changing intervening in certain markets. All of these have direct implications for the people and households owning these assets that are affected. So central banks' response to that is so far that monetary easing and accommodative monetary policy helps people at the bottom of the income distribution, and that is, I think, that is also true. But it also has distributional effects, especially the asset price changes that come with accommodative monetary policy shocks have particular implications for the people who hold these assets. And just to illustrate that point, let me briefly share my screen and show you for the US the Lorentz curve of portfolio gains from asset price changes, and you will get the sense, without going too much into detail, that this is here, that these gains are highly concentrated at the top of the distribution. What does that mean? That means that a lot of what's happening in the short run in asset markets when central banks interact in asset markets benefits financially a very narrow share of the population. So you see this here, that almost like the top 5% capture almost 80 or more % of the asset price gains that happen after monetary policy shocks. And these shocks with asset purchase programs, they are very direct, but recent research also, this is taken from the recent paper of Pascal Paul, thinks now that these asset price effects, mainly through risk premium channels of monetary policy, and we've heard this, in respect to capital flows to emerging markets, these asset price effects are very large. So on stock prices, 100 basis point easing is worth 10 or 12% on the S&P over multiple years, and they're quite persistent. So over the horizon of a business cycle or of an electoral cycle, for sure, there is quite a redistributive or a distributional effect coming from that. And obviously what we want to do is we want to compare two effects. Namely, we want to compare the portfolio effects of monetary policy that if happens in Hank models very naturally, because they build on these different portfolios between rich and poor, liquid and illiquid, etc. households. We want to compare those effects to the earnings effects. And we did that in a recent paper where we look at the effects of monetary policy on black and white households in America. We pick that distinction as there's a big debate now about race, obviously in an important debate in America. And if you compare the earnings effect from an easing shock to the portfolio effect of an easing shock, and you do that over 5 years, the result is, and you see this here in this chart, this is in % of group income, the portfolio effect that in this scenario mainly accrues to white households, because white households happen to own most of the assets in the US economy, is worth about, this is a 100 basis point easing shock, there's a 5-year horizon, we're estimating this with Survey of Consumer Finance data, and obviously there's confidence bands, etc. But we think that's roughly worth the relative wealth gain of white households over black households is worth 17% of white income. That's a one-off effect, and it goes down to like 16% after year 5, but it's a large effect. If you think about, that's relative to annual income, these are very substantial numbers. And if you compare that to the earnings effect that mainly benefits black households or minority households at the bottom of the distribution, yes, there are earnings effects, and there's more employment created at the bottom of the distribution than at the top. So monetary policy helps labor market inclusion. It helps people come into the labor market, and those people earn a salary, and it's all great. But these earnings effects are very small compared to these large portfolio effects that rich households get. So that's another, I think, fault line, to use Raghu Rajan's words, to think about for the future. And I think there's a decent a risk or probability that central banks will be drawn into these distributional questions. And it's harder to say now in this new world that there isn't a distribution effect, that's not what central banks do. Recent research very much suggests that is the case. Let me make one more point, but it's really going to be quick as I'm already at 10 minutes. I think another fault line is for the next decade or so is that central banks have made the world safer by taking out risks. They've stabilized the world successfully, but by stabilizing the economy, they've also invited additional risk taking, and in the form of debt and more financial intensity. And that might be a good thing up to a certain point, but it also makes the economy riskier. So richer too, but mostly also riskier. So what's happening, and I think what we're seeing in what some people at least argue, is that central banks have to run ever faster just to stand still, because the buildup of leverage in the background makes the economy inherently more unstable. And with every shock that's coming, we have to do ever more and take ever larger action just to stabilize. So this is another, I think, angle that we haven't really solved, how we can avoid that the good intentions of stabilizing the economy and taking aggregate risk out of the economy invites more risk-taking, more debt buildup, and by that kind of undoes the effects of stabilization policy. That what we see in the data is that, yes, great moderation, to come back to where I started, there is, at the surface, our economies seem safer and more stable. But if you look at big disasters, if you look at tail events, if you look at financial crises and their severe aftermath, the world hasn't become safer in the last 30 years. And I think that's a homework that we have to do and think about how we combine these two thoughts. I'll leave it here. Thanks so much for inviting me and looking forward to the discussion.
Thank you very much, Professor Schullerich. That was really, really interesting. I have a couple of questions here before I go on to the public's questions. Let me ask first a question to Luis and to Giovanni, and going a little bit deeper into the current inflation situation in, let's say, in the region, or in other EMEs too, but specifically or particularly in the region. A lot has been talked about, these base effects, also the high commodity prices. Of course, depends on the kind of fiscal stimulus that different countries put out there. For example, Brazil, a very large one, Mexico, a very small one, and so on. But I think that one has to be very careful in how much weight one puts to what somebody or some people call let's say, the output gap, because usually the output gap, or the compression of aggregate demand that we have been seeing, or that we saw during the worst part of the pandemic, is not due to usual business cycle dynamics. That is, it's not aggregate demand responding to prices in the economy. It's basically the result of a lockdown. It's an induced aggregate demand, let's say, recession. And of course, in order to gauge the effectiveness of these lockdown measures, the more one reduced aggregate demand, it will probably be reflected in lower GDP growth, a bigger recession, but then the possibility of recovering quicker. So in order to gauge that, one would have to look at, let's say, GDP intertemporally. My question to you is, doesn't this sign or is a sign that perhaps inflation is a little bit more problematic for some of these countries in the following sense? Now that economies are opening up, you have demand going to, let's say, or at least for those that were able to survive the pandemic, going back to normal levels, let's say, reflecting usual consumption patterns, plus the monetary or fiscal stimulus that was put in place. So you do have quite a lot of aggregate demand coming over and above just what, what reflects the monetary stimulus. In that sense, basically, some of these very high inflation readings in these countries probably are reflecting an accommodation of monetary policy, of this stimulus, and thus a reflection on prices. What do you think of that? That of course, would lead to a much more problematic view of inflation than just, these are base effects and supply disruptions are going to work themselves off and so on, and be very sanguine about this. So what do you think about this, Luis and Giovanni? Luis, please.
Thanks, Manuel. I would share your concern about, some of the this is not a traditional, recession that one induced by the pandemic, and its impact. I think that it's only going to be more evident over time. There's a lot of elements that are, quite unprecedented. For example, we have, in our models, these, tailored rules that tell us, okay, based on, the output gap that we measured, with pre-pandemic levels of potential growth, where interest rates should be at this stage. But guess what? It is a huge bet to assume that the output gaps or the potential growth is going to go back to where it was pre-pandemic in the coming years. It is possible that there is lasting damage that is done to many of these economies, and as you well pointed out, in order to accelerate the recovery, there is a lot of aggregate demand that is being, part of it is just pent-up demand because we have all been locked up for so long, and we're desperate to go out and spend and travel and get on planes and etc. And there's a lot of fiscal stimulus that is being injected into this economy. So. But it is possible that the supply side, doesn't respond because it is being permanently damaged, and that is the part that we are not yet, certain. And I'm sure there's going to be quite a variety of cases and dispersion across countries. So, with so much demand and a supply that is not able to catch up to that demand, all this talk about, this is just temporary, don't worry, may not be so, or the duration of this inflation bout, could be much longer than expected. So I would say that possibly inflation is going to be more of a problem than what we are considering here, and I would probably mention this as a key risk as part of the unknowns of emerging from this pandemic dynamics and all the policies that were implemented on the back of it. I will say, but I had some comments about what the interesting remarks of Maurice that I will say for when you finish this round of questions, Manuel. Thanks.
Thank you, Luis. Giovanni, please.
I think it's a critical question, and it's not easy to give an answer. The sort of interesting thing is that it really hinges on what you think about supply disruptions. So to some extent, to have a benign view of inflation, you need to think that there are significant supply disruptions, but you also need to think that these supply disruptions are not here to stay. So they need to be significant, but not too significant. Because if they are too significant, then we are going to see inflation accelerate, for a few months or maybe years. If they are not significant at all, then the source of inflation is something else. So it's sort of there is a Goldilocks region of supply disruptions that justifies a benign optimism about inflation situation. I think that there are two other aspects to keep in mind. So one is that there could be relatively persistent, if not permanent, changes in aggregate demand, in the structure of aggregate demand. This is certainly true in advanced economies. I'm not an expert on emerging markets, and I never lived in one, and so I don't know to what extent the changes in behavior that we have seen in most advanced economies are there too. And having been in the US this past year and a half, and I just spent a week in Italy, I can tell you that even between the US and Italy is very different. The degree of remote working and things like that are completely different. And so the degree of structural change that the pandemic will bring is not the same across advanced economies. And I expect it not to be the same in emerging markets as well. But if you have changes in aggregate demand, essentially inflation is not ergodic. So the models that we use to interpret seasonally adjusted inflation today, they may not be that accurate at the moment. I think the third point I want to make is something I pointed out during my presentation, is that I'm not too worried about inflation in countries with credible central banks and a sound fiscal framework. I mean, ultimately, all the really bad episodes with inflation, both in advanced economies in countries like mine, in the 70s, and especially in emerging markets, come from fiscal. When there isn't fiscal pressure, yeah, we may have inflation going above target for a while, even significantly above target, but the central bank is going to be able to bring it in. The problem is when you have a fiscal situation that doesn't allow the central bank to tighten when it needs to tighten, that's when you get inflation really out of control. So I think that's where you see heterogeneity across markets again. And that is, in my view, that's where we should be worried about. It's not, if we get inflation high for a couple of months or 3 months or 6 months, it's not going to be the end of the world. But if this leads to a central bank that is captive of the treasury, that's a completely different story.
Thank you very much, Giovanni. Let me put one quick question to Eline. And the question is, and I know that your connection is a little bit unstable, so let's hope that I can get it through. And the question is, when you were mentioning that QE in some of these economies are here to stay because it improves monetary transmission, I don't know whether that would be really the central point. The central point goes to the different rationales of using QE in these kind of central banks. And the main one is improving, let's say, and perhaps not, the word is not even improving, is making, let's say, under stress situation, systemic stress situation, bond markets function. If you don't have bond markets functioning, then forget about monetary policy. You don't have anything functioning. Basically, we know very, very well from the new kind of player that we have in financial markets, plus the very low natural rates in the US that seem to be persisting, that you will have sort of like herd type behavior in global asset managers and so on. And these leads in many occasions by the way they trade and so on, that just bond markets freeze. And in that sense, the liquidity provision that is the first and I think most important QE rationale is the one that is basically function, not really additional stimulus to aggregate demand or even monetizing the fiscal deficit. I think in these kind of countries, basically the main point is the making sure that bond markets function under condition of intense systemic stress. What do you think about that?
Thank you so much. No, I think I did write about it for a while, especially after the taper tantrum as well, about the new structure of the global financial markets. And again, this is my personal views, of course. But I think if I were to comment on the next global financial crisis, and of course, Moritz talked about this wealth aspects, which I think are a fantastic addition to our conversation. But staying with the sort of the more traditional analysis, I think this a large complex global asset managers, financial institutions that are all mostly allocating according to the benchmark, and are also now more moving into the market sort of market intermediation function as well. I think that's the next global financial crisis. And what we've done was the monetary policy post the global financial crisis, we flattened the yield curves, we made them much lower. We've regulated the banks. Where did the money go? The money didn't disappear. The money went towards the asset management community. And of course, as my colleagues here, Giovanni and Luis, they know very well, when there is a large asset manager trying to go through and buy government bonds in any country, they're just too big. And they tend to go sort of in swings in and out. And the way out, given the fact that the banks do not have management books anymore, there's nobody else on the way out. And if you underperform a benchmark, that's your problem as an asset manager. If you underperform with the benchmark, then it's not your problem, right? So then we have the situations where asset managers need to stay invested in cases, for example, like Venezuela, even though many years in advance, you might be worried about the ability and the willingness to repay of the certain country, but because it's a hefty part of your benchmark and it's very yieldy, it's very expensive for you not to be invested in that part of the benchmark until you actually have a restructuring case, and then oftentimes it's just too late for you to get out. And for even medium-sized asset manager to be able to get out, even a year before a potential event, you're just too big. You just won't be able. It's almost like playing poker, right? You cannot show your hand, and you're just trying to hold on and hope for the best. So I think this is global. I think it's a huge issue. And we often hear from central banks and or global sort of potential regulatory agencies that there are two arguments. One is they don't take leverage. Another one is they're not deposit insurance, right? So therefore, it's not our problem. Well, on the leverage part, if you're all invested in one way and in the way that sort of as you said, that there is possibility of very high disconnect in pricing, right? It's in old days, you used to think on Bloomberg that you just don't find the price, right? So you're a bit nervous, you're trying to find over the counter some price. Nowadays, there is a false perception that there is a price because Bloomberg shows something, but when you try to trade, there won't be a price. So, there's a false sense of security. So there is discontinuity and the market, and also there is liquidity mismatch. You're promising very short-term maturity to your investors, and oftentimes you're going into local bonds in emerging markets or frontier markets, and some of them are even going further than that. So there is also this liquidity mismatch as well. So it sounds very familiar to global financial crisis. And on the side of the fact that they're not deposit insured, well, a lot of them manage pension insurance fund money. Politically, they will end up de facto being insured. The governments will have to step in, and also because of what you just mentioned, the functioning of the local bond market. So long story short, I very much agree with your comment. I think it's important for functioning of the domestic bond markets, but I think it's also important for the transmission of the monetary policy market, right? If you're cutting rates and at the same time your curve is steepening, you're not sort of going up all across, right? And especially steepening in the back end, you might not actually be showing the sort of the easing of the financial conditions that you would like to have. So I think that's why also it is here to stay, because it's no longer, it's no longer trilemma, it's dilemma, even though you have a flexible exchange rate regimes. And then final on the fiscal part, I very much agree with Giovanni as well, is that it's sort of fiscal dominance concern. There will be some countries that will be left out in the cold where maybe inflation does pick up more meaningfully, but they won't be able to hike and they will not be able to roll back on their special monetary policy instruments because fiscal is just not capable of financing. The concessional funding is not the same this year or definitely next year, but their ability to scale back fiscal is much more complicated.
Thank you very much, Elena. We are out of time. Let me just finish with two things. And unfortunately, given that we have no more time, I'm not going to be able to pose either myself or Luis a question to Professor Schularik, to Moritz. I think he has really stated some very important issues going forward. Let's just say that some of these distributional issues, I think, have given place or are really transforming not only the central bank, but also the, let's say, pressure that society is putting on their governments, on their elected governments, let alone the central bank, which I think certainly has to change with the times in the coming years. But just look as an example at the Pacific countries in Latin America, and just at the latest cycles of elections in the four main countries, and you'll see that basically these distributional aspects, not only in terms of central banking, but just is basically leading to a rethink or the need for rethinking institutions, rethinking laws, rethinking basically everything, the way people interact politically, economically, and socially in this country. So I think that the point that Moritz forth in the case of central banks is just crucial for the coming years. So let me just thank, and again, we are out of time. Let me thank all four panelists. I think there were wonderful presentations. I think it was a very, very fruitful discussion. So thank you to all of you, and we'll go on to the next session in a few minutes. So Mariela, I'll hand the mic over to you.
Thank you very much to all the panelists. Thank you very much, Mr. Manuel Ramos-Francia. We're gonna start our third session, Central Banking in a New Era. We have Eric Parrado, Chief Economist of the Inter-American Development Bank, as the chair. Mr. Parrado, the microphone is yours.
Thank you, Mariela. Do you hear me well? Can you see me now?
Yes, all good, thank you.
Perfect, thank you. I'm having some problems with my laptop right now. But anyways, welcome everyone to the last session of the conference titled Central Banking in a New Era. So far, we have had some great discussions about the challenges facing emerging economies and insights on the next global financial cycle. This last session takes a closer look at what central banks in developed and emerging economies might face once the next global financial crisis begins to unfold. As we all gradually move towards a post-pandemic economy, countries, and in particular central banks, face lingering issues as well as medium-term challenges. The shifting global landscape lends greater significance to the interplay between monetary, financial, and fiscal policy. However, there is less clarity on how this interplay should be conducted. Issues such as climate change, economic inequality, and the use of digital currencies are some of the features of this changing landscape. To discuss all these aspects, we have a fantastic panel with 4 policymakers. They truly don't need any introduction. We have Margarita Delgado, Deputy Governor of the Bank of Spain, our host, Julio Velarde, Governor of the Central Reserve Bank of Peru, Alejandro Díaz de León, Governor of the Central Bank of Mexico, and Leonardo Villar, Governor of the Central Bank of Colombia. As you can see, it is an impressive panel. As we have done in previous sessions, each speaker will talk for 10 minutes. Afterwards, we will have a short discussion and then we will open the floor for questions and comments from the audience. So with that, please go ahead, Margarita Delgado. Thank you very much.
Hello, good afternoon, good evening. Well, let me start by referring to the ongoing global recovery. I think it is useful to make some comments before addressing some aspects of the future on central banking. As we all know, the COVID-19 crisis, health crisis, has been characterized by an extraordinary heterogeneity across countries. Indeed, factors conditioning the severity of the economic impact are the intensity of the pandemic, of course, in each country, the stringency and duration of the containment measures taken, but also the productive specialization of our economies. In my view, the economic impact on the most social intensive service sectors has been harsher and more persistent. These sectors are particularly labor intensive, and employment is more geared to a younger, female, and less skilled population. This aspect, of course, made economic policy intervention all the more necessary in order to mitigate the social impact of the pandemic. And the economic policy response has been a further source of kind of asymmetry. Also, all these factors are conditioning the recovery path, which is also uneven by countries and economic sectors, with many of them experiencing a stop-and-go recovery. Indeed, for example, the US is expected to regain its pandemic GDP level in 2021, and the euro area in early 22. However, the heterogeneity within the euro area is also strong. On the latest ECB from the European Central Bank forecasts, Germany, for example, will reach the pre-pandemic GDP level in 2021 and the euro area in early 22. However, for example, in the case of the output in Spain and Italy, we will be more in the side of the 22 year, right? So also, as I said, this heterogeneity is partly driven by the big differences in the production structure. For instance, Spain and Italy are more focused in social activities, which are more relevant, such as tourism and hospitality industry, which is less important in Germany. Of course, on the other hand, the prospects for emerging market economies are slightly deteriorating, with the main exception of China, given negative pandemic developments and still low vaccine rollouts, both impeding the normalization of their activity. Indeed, I think that the outlook for Latin America as a whole is a bit diverged. And in our view, it will recover the pre-crisis GDP in 2022, whereas Eastern Europe and emerging Asia will already attain in 2021. We expect a very strong economic rebound in the second half of this year in most advanced economies. And this rebound, of course, is triggered by the vaccination rollout, the opening of the economies, and the economic policy stimulus. However, despite these bright prospectus, there are some risks emerging which could lead to an unsteady recovery in some sectors. These risks are related to the resurgence of the new variants of the virus, and also the emergence of bottlenecks in some manufacturing sectors. Emerging economies are particularly vulnerable to the virus, given the still low on average vaccination rollout. But in general, available data so far seem to confirm that the economic scenario for the second part of the year will be very positive. But I think we need to reflect about the longer term horizon. What about over the longer term horizon? A key question is whether this rebound that comes with the reopening and the stimuli will give way to a solid and sustained recovery. The hardest hit economies are likely to face more scaring effects and face a slower and more uncertain recovery. Some sectors will foreseeably witness a structural decline in demand, for example, as a result of more extensive teleworking. Accordingly, economic policy measures should continue supporting the recovery and help the structural transformation of our economies. And this includes addressing medium-term challenges, such as, among others, those related to climate change and digitalization. And with this, back to you. Thank you very much.
Thank you very much, Margarita, for your initial comments. Very important to have this analysis in terms of the regional differences. It's very interesting here at the ADB, we have this idea of that the crisis hit us, Latin America, with a triple sun stop in terms of an impact on human mobility, on trade and financial flows. But the impact is very interesting because when we compare the European Union and Latin America, in terms of if we have done a good job in terms of the economy and also in terms of the health sector, we are in the same and similar shape. So it's very interesting to understand, probably later on in the discussion, what are the main differences that it could be hidden in these numbers. Having said that, I would like to give the floor to our host, Julio Velarde. So Julio, the floor is yours.
Thank you very much. It's a pleasure to be with you again. Actually, Margarita has said a lot of things. I agree with her. But let me start maybe for something that was said by Manuel Ramos-Francia at the end, by Barry, and also by Margarita. Probably the prospects for Latin American economies are not so good. Political factors were mentioned, but also potential output probably for the years are not so good. Of these bigger economies, you know, Argentina, and I'm not going to talk about that. Brazil has a populist government, and probably the left is going to win in the next elections. Mexico has a populist government. And three countries that have had still have very strong economic fundamentals have had a lot of political disturbance. I talk about Chile, Colombia, and Peru. In spite of a quick recovery that I'm going to mention, I believe I should mention this in a certain way. I will start some of the comments. Some aspects of monetary policy are going to stay here and are more structural. I would say one factor is demographics. That is more important, of course, for developed countries, particularly rich countries. But the effect of savings on less consumption, the effect on the natural rate of interest on potential output is becoming more and more important. And the case of Japan is something that has to be taken into account. It's not going to be similar, but some of the same problems are appearing in many of the more developed countries. And in other countries also, the difference probably in emerging market countries, even in Latin America, or some Asian countries, is probably they have less wealth, less accumulation of wealth. So probably the effects might be somewhat different, but they are important. Other factors that were mentioned by Maurice, I believe, are pretty important. Part of the discussion in many central banks, not so much in emerging markets, because I believe it has to do with how monetary policy has been implemented through capital markets. That is why probably is more important even the discussion in Anglo-Saxon countries, where capital markets are more important than even other developed countries. How income inequality is affecting the effectiveness of monetary policy. And that was mentioned by Maurice at the end of the last session. And I believe it's pretty important. The other problem that was partly mentioned by Maurice is the problem of we have last year been very expansionary in fiscal terms, and not only last year, but last year was dramatic. And the level of debt of developed countries is pretty high. And that puts some constraints, or it might have some effects, or when that stimulus, monetary stimulus, has to be removed at a certain time. But the other factor that I would like to mention is I have been governor for 15 years. I have talked probably with 500 governors around this year, even in the Bundesbank. I have known, since Steve Mayer, I have known all the governors, I believe, from the Bundesbank. Actually, when we talk about controlling inflation, is that we are not concerned about employment or level of economic activity. Of course, with inflation targeting, if you react only to demand factors, you are working in both directions. But most of the central bank governors I have known have always taken into account employment or level of economic activity if this was not going to affect inflation. And they typically have not reacted to supply factors unless expectations start to be contaminated. But just to finish, a lot of the people here are from Latin America, and for Latin Americans, economic stability has been fundamental. We cannot grow if we do not have a stable floor where to build economy. The first time I was a member of the board in Peru, it was after hyperinflation. And we have had terrible 80s in Latin America with high inflation, macro policy that were all wrong, etc. So I know you are not trying to say that, but stability is pretty important. Low inflation is pretty important. With inflation, actually, you don't know how to allocate resources. Prices change continuously. And you can see that in countries, even in Latin America, like Argentina, for not talking about Venezuela or other countries. No? But let me start what I was trying to say first. There are still a lot of problems that were mentioned by Margarita. There is still a lot of uncertainty. Still, we don't know even how long the effects of the vaccines are going to last. We don't know about new strains of COVID. Some sectors are still pretty well affected. So we have to take everything with some doses of caution. But even so, the recovery has been pretty strong. in many of the countries. Eric mentioned Europe and Latin America. Actually, in Latin America, even the fourth quarter and the first quarter, that compared to 12 months ago, the recovery has been faster than at least in the 6 bigger economies in Europe. In our case, already in December, we had almost the same level pre-pandemic. And the numbers of May, that are our last numbers of GDP, the GDP is 0.4 below the levels of 2019. And that is strong. I was thinking about what we were discussing just in March or April of last year, when the start of the lockdowns started in most of the countries. And actually, we were very much concerned about the duration of the crisis. We didn't know what was going to happen. At that time, we believed that a lot of firms were going to go under the water. A lot of firms went under the water, but I am surprised of how many firms have survived and have reacted pretty strongly. And also part of we spent a lot of days and weeks discussing the financial system, how it was going to be affected. We're talking with people around the world about a possible banking crisis, etc. Actually, because of the recovery that has been so quick, we have seen that the solvency of the financial system remains pretty strong. And actually, most of the banks have already recovered their profits before pandemic. And that is very important. We still have some factors that are affecting us, and some are political factors. And just to connect again with what was mentioned by Manuel Ramos-Francia, in our case, for example, we have grown 4.8% this century, until 2019, of course. Poverty was reduced from 58 to 20%. Inflation average was a little more than 2%, which was our target. But even so, the COVID, the pandemic, the increase in unemployment, because of a lockdown of almost 4 months, have increased the demands for change very strongly. And we have had for the first time in 200 years, the election of the most extreme left candidate that has won the election. And this part has been disappointment with some of these aspects, in spite of the performance that has not been bad at all. But well, this uncertainty continues. But besides this uncertainty and the challenges we had, I would say that the recovery has been pretty strong, but we don't know. We believe that the scars, the long-lasting effects are not going to be so strong. Luis Oganes mentioned that we don't know, of course. There are some factors like education that will probably affect potential growth in the future. We have had almost 2 years with people not going physically to schools, and that has affected education. But even so, the improvement has been pretty dramatic. And that has been because of many factors. In spite of having less space than developed countries, most of the Latin American countries, and I want to say emerging market countries in general, have responded with very expansionary fiscal policies. In our case, we added almost 7 points of fiscal stimulus of GDP. A monetary policy has been more expansionary than ever before in most of the emerging market countries. During the crisis of 2008-2009, we injected about 2% of GDP in liquidity, and we were the second emerging market countries with a lower interest rate, with Thailand, with 1.25. In this occasion, we injected 8% of liquidity of GDP of liquidity, and reduced the interest rate to 0.25, which was the lowest in emerging markets until Israel and Poland reduced the interest rate to 0.1. But it has been very strong, the response. And in part, it has been the credibility that central banks have obtained in the region, at least part of them, a good number of them. No? And I believe that is very important. One point that I want to mention, employment has recovered, but not as a strong economic activity. This letter K that has been mentioned many times by a lot of people actually more or less describes what has happened. Sectors like construction, part of manufacturing, have recovered pretty strongly, but sectors linked to the hospitality sectors are still very much affected, hotel, restaurants, etc. And probably that makes us to the need to maintain expansionary policy for some time. And that is very important. These sectors that have been affected are very intensive in labor. And in spite of the employment situation improving, we're still below the pre-pandemic levels. In the case of formal employment, we are almost 4% below the pre-pandemic level. And that is because these sectors, intensive in labor, restaurants, etc., have been pretty affected. And also one factor that we have seen that the population that has been more affected has been single women with small children. In part because there is no school, they have tended to stay home to take care of their children. That is a supply factor that is also increasing. We believe that as vaccination improves, we are going probably to have these sectors already operating. Just to mention, in the case at least of the bigger countries of Latin America, most of them will have most of their population vaccinated this quarter. Others in our case, for example, we expect to finish around probably October. We already have around 4 times the number of vaccines than the population, the adult population. The problem is that a good part of that is arriving until October. We have only received to July 20 million doses. But this year, in any case, up to October, I would say of the 6 bigger economies of Latin America, most of the population will be vaccinated, and that will be a big change. Of course, we still have the concerns about the new strains of the virus, etc. But in any case, it's a good news, I believe. Yeah, just to finish, inflation. Inflation has been lower in the case than other countries in Latin America, but it's above our target. Our target is 2 ± 1. Inflation is in 3.25, but core inflation remains below 2%. We have seen the increase in commodity prices because of political factors. We also had a big depreciation for Peru and for other countries, 19%, almost 18% in the last 2 years. But we have to take into account probably some increases in inflation that we're going to see. For example, discotheques, gyms are still not open. So inflation there appears still like zero. We are keeping the prices of before. Probably we will see an increase in prices also when they open. And the other factors is the pent-up demand. The private savings, the last quarter of last year, for example, will almost double of the historical level of private savings over GDP. So probably as soon as they open, we will have some spending, and probably that will have some effect on inflation. But our concern is still inflationary expectations are pretty well anchored. In our last 2 communiques, we were not hawkish, but we're probably less dovish. In the last communique, we changed from a strongly expansionary monetary policy to just expansionary monetary policy. And while the market was expecting an increase in rates next year, now they think it is going to be the first hike this year. Of the 5 bigger Latin American countries with inflation targeting, 3 have already increased their interest rates: Brazil, Mexico, and Chile. Colombia and Peru have not done it yet. But the removal of monetary stimulus, in our case, is being discussed more that we don't need this extraordinary supportive monetary policy. Not that is, we still need expansionary monetary policy, but not so strong expansionary, because we're already close to the pre-pandemic levels. Of course, inflation is a concern. We don't know yet. The last inflation that I remember, the strong inflation, was 2008, with also an increasing commodity prices. At that time, also the inflation on August of 2008 was 5.4%, like the inflation today of the United States. But at that time, what corrected inflation was the big recession. We don't want that to happen. Actually, we have to be careful. I still believe that it's going to be transitory. It was mentioned the last session that these disruptions are probably transitory, but we have to be careful. We don't want to repeat the experience of the 70s. If this high inflation remains for more than 1 year, 1 year and a half, 2 years, I might be concerned that inflation expectations might be affected. And that will be a problem, but until now we expect it to be transitory. And just to finish, because I believe I am talking too much, central banks have become popular because of what they did when the financial crisis broadly developed central banks in developed countries. In our case, we got out of the crisis of 2008 more quickly because of the impulse of China, et cetera, other factors. But one thing is to have inflation below target, as has happened during the last 10 years in developed markets. Other thing is to have inflation above target. That makes a central bank much less popular than when you are missing your target because you are below. And just to finish, what I believe what we have done probably in emerging markets in the last year and a half have also reinforced the image of the central banks. And that can lead to some concerns. I'm just going to mention one. For example, as in Chile, in Peru, the Congress approved laws that allowed the withdrawal of private pension funds. We bought some bonds and we do some repos so as not to affect the financial markets. And now the Congress believes that the central bank can do it, that always, in spite of the political situation, etc. So they believe we can do much more than what we effectively can deliver. And that is a problem. And that problem in the future might be fiscal dominance if we don't control in the next years the increase that we have seen in the deficit. No? And I will stay there. Thank you, Rick.
Oh, thank you very much, Julio. As usual, very open and candid comments, and you tackle a lot of issues that are really interesting. I can stress the uncertainty about the recovery. So the big numbers now in 2021 looks very promising, but the risks are really, really high. You mentioned the political discussion, political polarization, income inequality, of course, and the social unrest in some Latin American countries, and also, of course, the fiscal issue that is going to become a burden in the next years. So with that, I will leave the floor to Alejandro Díaz de León, Governor of the Central Bank of Mexico. So Alejandro, please go ahead.
Thank you. First, let me thank the organizers of today's conference, Marc, Uzan, Julio Velarde, and Eric Parrado. It's an honor to share this panel with my colleagues. To address today's topic of central banking in a new area, and central banking is a broad topic, I will make some remarks on 4 issues. 1, monetary policy. 2nd, financial stability. 3rd, payment systems. And 4th, on climate change. Regarding monetary policy, central banks in emerging economies clearly face a more complex set of trade-offs than their counterparts in advanced economies. In the small open economies, which supplement domestic savings with external financial resources, it is essential to preserve a sound policy mix to foster an orderly adjustment of the economy to adverse shocks and to attract capital flows. In these economies, external and idiosyncratic shocks, politics, social, or whatever, not only affect the demand side, but also the supply side, as well as the financial markets, which tend to increase policy trade-offs. In advanced economies in the last decades, several structural factors and demographic trends have induced lower potential GDP growth, lower inflation, and lower real neutral interest rates. This has resulted in a sustained trend of low and below target inflation for long periods of time. This allows advanced economy central banks to be extremely patient in the wake of higher inflation. Emerging markets are not in the same position. We have less policy space. Price formation has not been dominated by chronically low inflation, and inflation expectations have not been persistently below target. We need to be mindful of a more flexible and agile price formation process. In addition, as we have been recently reminded, emerging market economies continue to be exposed to different types of adverse idiosyncratic factors that limit investment, potential GDP growth, and hamper development. Furthermore, the complex post-pandemic environment presents significant challenges. Let me mention a few. First, the global economy is highly heterogeneous and in uncharted territory. Second, fiscal support, mainly in the US, is currently at unprecedented levels, helping the recovery, but adding inflationary pressures. Third, post-pandemic price and wage dynamics are highly uncertain. Four, recent changes in the monetary policy strategy of both the Fed and the ECB are untested and could add uncertainty. Fifth, several emerging markets are already facing upward inflation pressures at a time when output remains below potential. Thus, inflation gap is positive and output gap remains negative, and financial markets are prone to volatility episodes. And although the shocks that have affected inflation are expected to be of transitory nature, given the variety, the magnitude, and the extended time frame in which they have been affecting inflation, they may pose a risk to the price formation process. Monetary authorities are likely to continue to face very difficult trade-offs. And regarding monetary policy instruments, I think asset purchases programs are not over the counter in emerging markets. Policymakers need to be mindful that central bank financing to governments can fall into a situation of fiscal dominance. Stress tests of fiscal sustainability and availability of resources of finance are needed to avoid situations that could lead to financial repression or monetization of fiscal deficits. Unfortunately, the region has had many painful episodes that has caused incommensurable, long-lasting damage. Also, if asset purchase programs in emerging markets were perceived as central bank financing to governments, it would exert pressure on risk premia, the exchange rate, and capital outflows, contrary to our original objective of easing financial conditions. Thus, it is necessary to act prudently and to follow a robust policy approach, contributing to a solid macroeconomic fundamentals and to an orderly adjustment of markets and relative prices. Now, let me have a few words on financial stability. COVID-19 shock has allowed us to test the international agreed regulatory reforms, which have attained more resilient financial institutions and stronger capital and liquidity buffers. Even though the current crisis is not over, the regulatory reforms seem to have worked. And now to a challenge. Technological innovation represents a major opportunity and challenge for the financial system. We need to make the best use of technology for the benefit of our society. This is particularly important for emerging markets, given the opportunity to attain more inclusive and deeper financial systems vis-a-vis advanced economies where they already have deep financial systems. We also need to avoid the growth of the unrestrained shadow tech banking system prone to regulatory arbitrage. We must ensure that same risks are treated in the same way, regardless of the provider of the service. Opening to new players and new ways of providing financial services require aiming for efficiency, effectiveness, and inclusion, while keeping the right checks and balances on all participants. Now, let me say a few words on payment systems. Payment systems landscape is currently facing one of the deepest and more challenging changes in history. Advances in technology and innovation have challenged domestic and cross-border payments, and these entail critical trade-offs for policymakers. It is of the utmost importance for central banks to assess how new technologies may contribute to their mandate of providing money to our societies and to developing payment systems as public goods that contribute to facilitate fast, low-cost, and scalable payments alternatives for a broad range of users. Since the origins of fiduciary money, authorities have not faced a challenge where private digital payment solutions could induce a significant currency substitution. History has numerous examples where the generalized use of private money without a lender of last resort, combined with inadequate institutions and external or internal shocks, resulted in an economic crisis affecting significantly social welfare. Virtual assets are not to be legal tender to meet financial obligations or to be used as currency, but rather treated as commercial goods for all legal purposes. Crypto assets or tokens could have some medium of exchange properties, but they grossly fail as a store of value, unit of account, and as a fully acceptable and efficient payment instrument. Thus, crypto assets, these private crypto assets hungry for senior edge returns should not consolidate as acceptable barter tokens. The proposals involving central bank digital currencies emerge as means to protect the financial system and consumers from the risks of suboptimal outcomes from crypto assets and lightly regulated stable coins. It is imperative for central banks to address this challenge in the short term to preserve the public goods we provide in the provision of currency. This requires the central bank provision of digital payments alternative to households and firms, properly supported on policies focused on preserving its value and fostering its sound intermediation in the financial system. Realizing the benefits of CBDCs and digital payments come along with the implicit requirement to foster public payment infrastructure, including new domestic payment services, but also cross-border. The inclusion of new participants in digital financial ecosystems, the big techs and fintechs, which vary significantly in size and availability of resources, raises considerable long-term issues. And we clearly need to avoid some of the bad outcomes following the next anchors, policy anchors that I will highlight. Number one, same risk, same regulation. Number two, interoperability and network neutrality. Number three, avoid kingmakers, avoid entities that could extend market power from one place to the other. Fourth, business continuity with large foreign providers, since the failure of a payment service provider could have substantial spillovers. Fifth, addressing jurisdictional gaps. Sixth, client protection. And seventh, cybersecurity. Developing this public infrastructure should be at the top of the local and international agenda, since payment systems are inherent to central banks as a key part of their role to providing money to our societies. Now, a few words on sustainability and climate change. This is an additional exogenous shock that has gained relevance, and the financial system could play an important role in aligning incentives. Central banks related and climate-related financial risks is precisely, and the objective is to foster this alignment of incentives. I think that climate risks imply material financial risks affecting all countries and sectors. These material risks are related and should be included in a full risk management routine and in the business as usual in risk management. And I would say that open emerging markets are especially vulnerable to external shocks related to climate policies because carbon pricing, tariffs, or even fiscal policies can have an effect, especially on these open emerging markets. Recent proposals, for example, to establish a minimum carbon price must consider per capita income and carbon intensity considerations. I think international organizations as the NGFS and the FSB have advanced a lot in providing a roadmap in this agenda. And let me just have a final remark. Despite the stronger economic recovery expected for this year, the pandemic has left important economic challenges and social scars. Our societies and economies face multiple challenges and concerns, and the policy space is more limited. And we also face more numerous and more significant idiosyncratic social and structural challenges that can hamper development and constrain decision-making. The magnitude of the challenges that central banks face cannot be overstated. We need to recognize the urgency to work creatively and to cooperate effectively in order to attain a broad shared vision of the future and a roadmap to attain it. Thank you very much.
Thank you very much. Alejandro, you also tackled several important issues. Probably I can stress the issue on payments, which is a really important topic right now. We're trying to develop an initiative here at ADB on financial inclusion. So we are working across several divisions within the Inter-American Development Bank to tackle the issue in terms of the assessment and then the policy recommendations. And of course, we need this support from central banks and superintendency to understand first what are the main barriers and then implement following your comments. So thank you very much for that, Alejandro. And now we're going to have Leonardo Villar, who is the governor of the Central Bank of Colombia. So Leonardo, the screen is yours.
Thank you, Eric. It's a pleasure to attend this conference, and thank you very much to organizers, and to share my views on the new challenges faced by monetary authorities in this post-pandemic world. Let me start by sharing some comments on the response to the COVID-19 crisis by the Colombian authorities. In Colombia, the flexibility and soundness of our macroeconomic framework enabled Colombian authorities to respond promptly with a strong counter-cyclical monetary and fiscal policies. The implementation of a broad array of measures allowed the central bank to effectively address the pressures arising from the shock, providing liquidity to markets and reducing interest rates to record historical lows. So far, the central bank's reaction has provided a significant level of stimulus to support economic recovery, while inflation expectations remain close to the 3% central bank target. In the first 5 months of the year, the Colombian economy registered higher than expected growth, and it is benefiting from an expansionary monetary policy stance at historically low levels for the policy interest rate. However, the pandemic continues to negatively impinge on the economy, with still high numbers of infections and deaths per day, although they are starting to diminish during the last 2 weeks after a very long third wave that we had. Added to the impact of the pandemic, economic activity received a strong negative shock starting in late April, when social unrest erupted, sparked by the proposal of a comprehensive fiscal reform that was submitted by the government to Congress. Although this proposal was withdrawn by the government less than 1 week after it had been submitted, protests and social upheaval continued until early June, bringing along blockades and riots throughout the country. More recently, however, social unrest has diminished, and road blockades, which have had the most damaging effect on economic activity, have been lifted. Despite these adverse conditions, countercyclical and very expansionary monetary policy have been key to create conditions for a strong recovery of economic activity in Colombia. Indeed, the central bank staff expects GDP growth to reach 6.5% in 2021, and several analysts, both inside and outside the country, have even higher GDP growth forecasts, closer to 7.5%, while inflation expectations remain close to the 3% target, at least in 2 years' time. Perhaps a little bit higher than that in 2021. Labor market indicators, however, remain quite weak, with unemployment rates around 15% at the national level and 16% to 17% in the main urban areas. Now, beyond the relative success of countercyclical monetary policy, it still faces significant challenges stemming from changes in the country's risk perception due to the evolution of the pandemic and the fiscal outlook, and the risk of tighter global financial conditions due to the possibility of faster than expected normalization in US monetary policy. The risk of deterioration of the fiscal outlook is one of the main concerns regarding Colombia's macroeconomic stability. This is reflected by the fact that the S&P and Fitch ratings recently downgraded our rating below investment grade. Public debt rose from 50% to 65% of GDP during 2020, and this ratio is expected to increase in 2021. As a matter of fact, the fiscal deficit was 7.8% of GDP in 2020 and will be even higher in 2021 when it is expected to reach 8.5% of GDP. According to the financial plan of the Ministry of Finance, the fiscal deficit will still be around 7% of GDP in 2022, despite the expectation of approval of the tax reform that was submitted to Congress this week, which is, however, less ambitious than the one submitted in April. This situation has created significant pressures from some political parties and interest groups on the Banco de la República, on the central bank. Fortunately, the Colombian constitution grants the central bank a high degree of independence, and its independence has also been supported by the government. Nevertheless, the risk of fiscal dominance is one of the challenges we face at the current juncture. Emerging economies are affected by this phenomenon to a greater extent as the growing weakness of the fiscal sector restricts the scope of action of these economies, exposing them to complex trade-offs. The perception of possible monetary financing could undermine investors' confidence, affecting the central bank's credibility and constraining policymakers' room of maneuver. Furthermore, the increase in the US long-term rates has tightened financial conditions in emerging economies, along with the deterioration of the country's public finances and projections of higher public indebtedness. This situation poses a significant risk to the Colombian economy, exacerbating its vulnerabilities. Higher foreign interest rates and the deterioration in the perception of sovereign risk undermine investor confidence and may generate pressures on the exchange rate and inflation, thus further restricting the monetary authorities' room for maneuver. Hence, an important risk today is that we could go back to pro-cyclical monetary policy responses to exogenous shocks if international liquidity conditions become less favorable to EMEs under conditions that may negatively affect foreign investors' risk appetite and increase risk premium. In the above mentioned circumstances, the questions posed for this meeting on new goals for the central banks become very challenging. A possible compromise of the credibility of the inflation target makes it harder for the central bank to accommodate additional policy objectives as the trade-offs become more acute. For instance, incorporating social welfare aims may become even more difficult than before the pandemic. Of course, social welfare and income redistribution must remain at the top of the government's agenda in countries with very high inequality, as are most of the Latin American countries. However, the room for the central bank to contribute in achieving this goal is likely to be restricted to their role in avoiding a resumption in inflation and macroeconomic instability, which would have a strong negative impact on income distribution and social welfare. With regards to the use of digital currencies, the challenge is clearly within the traditional realm of central bank policy. Doubtless, central banks must get involved in the study of cryptocurrencies and stablecoins, since the basic functions with regards to payment systems, monetary policy, and financial stability are affected. Even before that, some central banks like Banco de la República must coordinate with other state agencies the adoption and the spread of domestic low-cost instant payment schemes that would provide most of the services of digital currencies within the perimeter of the traditional payment system. Likewise, the exploration of low-cost cross-border payment alternatives and CBDCs must be on the strategic agenda of central banks. Regarding climate change, central banks could advance along three lines that do not imply any compromise of their core objectives. First, central banks are, as corporations, can gradually adapt its internal facilities and procedures in pursuit of zero net carbon emissions. Banco de la República has actively moved in this direction in the cash production and distribution processes, in the adaptation of its buildings, and in other areas. Second, central banks may evaluate the inclusion of climate consideration in their monetary operations and international reserve management. However, this must consider the peculiarities of every country. For example, in Colombia, liquidity operations do not typically involve corporate bonds and will be susceptible to an environmental qualification. That will be susceptible to an environmental qualification. Similarly, any greening the international reserve portfolio is constrained by the size of the portfolio and by legal liquidity risk and return mandates. Third, central banks should accompany and monitor the introduction of climate and transition risks in the risk assessment of financial intermediaries. In the case of Colombia, this task belongs mainly to the financial superintendency, which is outside the central bank. However, Banco de la República follows this issue as part of its longer-term evaluation of financial stability. In a related strand, the central bank can contribute to the study of the macroeconomic effects of climate change and transition, acting as in its think tank role in a collaborative effort with other state agencies. I stop here. Thank you very much. Thank you, Eric.
Thank you very much, Leonardo. And you mentioned that one of the most important risks is, of course, the fiscal situation. And this is happening for all the countries, I would say, given the huge fiscal deficits of 2020 and the projection for 2021 and 2022. Our projection in terms of Latin American and the Caribbean debt is going to be around 80% in a couple of years. So I think we need to think about how to become more sustainable in terms of the fiscal expenditures. And that's going to be a huge challenge given all the social unrest that you also mentioned, and the political discussion that Julio also mentioned in his initial words. So thank you very much for that. Now I see that Diego Labat, Central Bank Governor of Uruguay, is in the audience. So I would like to give him some time if he's able to do it. Hi, Diego. So sorry for putting you in the spotlight, but we have to take advantage of you too. You're on mute. Still on mute.
Okay, here. Hello, Eric. Nice to meet you.
Nice meeting you. So Diego, probably if you can tell us something about what are the challenges in Uruguay, that would be great.
Okay, we are. I will start with about CBDC and the challenges. So some of you know, Uruguay has a CBDC pilot some years ago. For us, it was a good experience, but now we are in a hard time because we are thinking to start in just in real time, but it is difficult for us to complete all the process. But I think it is important for us, and then when we are completing the latest aspects of the project, just to announce this. We are working on some things like another banks in systems like PIX or CODI. Just for us, it is a very important challenges. Uruguay is not well ranked in the payment system infrastructure, and for us it is a challenge. During the pandemic, for us, we have some problems at the first times of the pandemic, and well, we made some discussions during last years, during 2020, and then we decided to improve our infrastructure. So for us, it is another important challenge. For me, it is important. Perhaps some of the speakers are big countries. One of the challenges for us is our volume, our scale. Just for small countries, sometimes it is very difficult to improve in this type of challenges. So for us, it is. And then,
but you have been the pioneers in terms of the CBDCs, so I think it's important to stress that, and probably we need more news on that rather than the implementation of Bitcoin in El Salvador.
No. We are working on a legal framework for cryptocurrencies, but no, we are not seeing to follow El Salvador. Just no. But it is a challenge for us. Just we are working on this. Just we want to announce the view of the Central Bank of Uruguay on cryptocurrencies, just to give a legal framework to all the participants. I understand that it is difficult, but for a small country like Uruguay, cryptocurrencies or another niches of the market could be interesting, but we have I don't know how I say, but we need to evaluate the trade-off between some advantages for a small country to take a hub on, for example, a hub on cryptocurrencies, but on the other side we have the climate, the business climate that you can deteriorate. So in Uruguay now we are discussing these kind of things, just to take a niche, or just to continue with a business climate that Uruguay has, and well, how to work on this trade-off.
Yeah, that's a good point in terms of that. Sometimes you have to take some risks to be more competitive or to accept other type of industries, but at the same time you have to be careful, very careful about the stability of your country. So I think those challenges are common in every country, I would say, in the world. So thank you very much for that, Diego. It was a really good contribution. So we have different countries, different challenges, but I think a common issue that I could extract from the discussion is the importance of the independence and the autonomy of central banks. I think that's an important issue, and probably that's going to be the first question that we would like to ask you. Today, given the political polarization, given the social unrest, now there is some challenging times for central banks to be independent and autonomous. And as some of you mentioned, also important to focus on the objectives of the central banks, which is price stability and financial stability in some cases. So probably we're going to agree on everything about the independence and autonomy, but what we can do in terms of convincing our society and our politicians regarding the value of the autonomy of central banks. So probably we can start with Margarita.
Thank you, Eric, for the very good question and very difficult to answer in a very candid manner. Well, in our position is clearly that we are an independent institution and we are protected by law. So this is really in our DNA, and we are very, although we are constantly collaborating with the government, of course, we are independent to choose the topics that we dive in, and we also analyze and publish. And our let's say our assessments are usually quite careful and very thorough. So when we come out with a kind of sensitive issue, such as, for example, in my country, the labor market reform or the pension reform, this is quite widely debated in the media. But still, we really believe, and we firmly believe, and of course, Pablo, as you all know, the governor from Banco de España, he's a firmly believer of our independence. And of course, we are defending that independence every day through our independent analysis, through our, let's say, function of assessment of to the government, and also in the parliament. So we defend ourselves, well, not defend ourselves, but we really believe that this is the right choice at the right time, and we really, let's say, protect our analysis and assessments through the different tools that we have. But this is, you know, that we don't have any more, let's say, the monetary policy in our hands. This belongs to the European Central Bank, of course, through the Governing Council, where every single European governor sits there. Recently, yesterday, and 2 weeks ago, we had the review and the revisit of the strategy for the monetary policy with very important decisions. I mean, this on the 2% for inflation, and also on the objectives for a longer term strategy, including, of course, climate risks and so on and so forth. So this is clearly something that goes with our nature, and we constantly defend this position, and I think that I believe that we are proud of it.
Thank you very much, Margarita, for that. And of course, the scheme is different in our region, so it will be great to have your thoughts, Julio, Leonardo, Alejandro, and Diego in some way. So try to be brief, so we have time for a discussion of a different topic.
No problem. We have in our constitution the autonomy. It has been changed 25 years ago, almost 3 decades ago. Before it was autonomous within the law, now it's autonomous within its law, the law of the central bank. In the last election, there were 17 candidates. All of them supported the autonomy of the central bank. Part can be communication, but it's not enough, I believe, is that the society has to see that inflation is low and stable. I don't know how much we can communicate. Margarita was talking before, there was in the 70s a Minister of Finance in Spain that was called, I am going to say it in Spanish, el abominable hombre de las nieves. Perdón, las 9. He spoke every time at 9 p.m. So you can, there are limits to communication. And I believe that the concern, if we have high inflation for some years, probably the respect for the central bank will be lower, no? But we have to fight for it in any case, no? Thank you.
Thank you, Julio. Alejandro.
Thank you, Eric. I think in the case of Mexico, our autonomy came as a result of 2 decades of very high inflation and financial crises. So in that regard, it has a broad support, but then again, this has to be gained continuously. And I would say that we face a significant challenge. I think central banks throughout the world, we are living in a world where, especially in advanced economies, anesthesia on several dimensions has been quite ample. And I think in emerging markets, which we have, as I said, a much limited policy space, we have a lower amount of anesthesia to provide. And that could create tensions as obviously societies and private markets and so on expect similar degrees of anesthesia. So that, I think, creates tension. And I think we are going to be, we need to be creative on how to communicate that sticking to our traditional mandate of low and stable inflation, it is the best contribution that we can have on several, on many dimensions. And we cannot put that in second place. That could be second to none of our other areas of objectives or areas of importance.
Perfect. Thank you, Alejandro. Leonardo, your turn.
Well, I share what has been said, but I want to stress something that is, in order to keep autonomy and independence, it is very important to have a very, very clear mandate, and a mandate which we can accomplish technically and without entering into topics or into issues that are very clearly political in the good sense of the word, social welfare or climate change are key objectives of the society, but they are very clearly tied to the government and to elected governments. So it's very important to avoid getting involved as central banks, as technical institutions, and as autonomous institutions into activities that should be led by elected bodies. And I think that is something very, very, very important. It doesn't say that, it doesn't mean that climate change is less important. It's more important perhaps, but we should not get involved too much in areas in which it is required to have elected bodies. It's like fiscal policy is essential. Of course, it is essential, but it should not be made by central banks. So I think that clarity about the mandates is key, and I think it's very important to communicate that to the public, why we concentrate and how, by fighting inflation and by contributing to stability, economic activity stabilization, we can contribute to social welfare and we can contribute to the main goals of the society.
Thank you, Leonardo. Sometimes there is the idea that since you are doing a really good job in terms of price stability and financial stability, you also can do a very good job in other grounds, and that's becoming a good thing on the one hand, but a problem on the other hand. So, Diego, you're on mute.
Yes, no, I came to the central bank on March 2020, just the first month of the pandemic. Just I arrived with a clear mandate to reinforce the the objective of inflation. As you know, Uruguay has a long history of inflation and a big problem of lack of credibility. Just for us, when I arrived, my main challenge was just to revert this lack of credibility. Just probably the first measure was to declare that for me the main objective is inflation and only inflation. In normal times, only inflation. Just in our law, in the Carta Orgánica of the Central Bank, just we have the two objectives. We have inflation and activity, and well, I have perhaps more tensions because I have a lack of credibility, inflation and 11%, but then I want to give the message of my commitment on inflation. Just for me, it was important just to show independence during the last 15 months. We had the idea just to present to the parliament a new law to reinforce this independence with some changes in the accountability, in the form to design the board, and some changes for us, some important changes. But during the pandemic, it was impossible for us just to go with this new law. But for us, it was a challenge. But for us, it was necessary just to recalculate and work with another alternative tools. Just we made a big reform on communication of the monetary policy. Just some reforms, just as we named just a new monetary policy framework. Just we write a paper just to reinforce our mandate, not in a law, but we try to do for another way, but trying to reinforce this independence. Just I think that we did the homework 1 year ago that we mentioned 1 year ago, but it is difficult in emergency times and in moments that the region is changing, or it is very difficult to send this message that we live in a non-stable region. In Uruguay, we have a tradition of some rules, but not in monetary policy. Just for me, it is very important to complete the rules that Uruguay have in most of the things. We complete with the monetary policy and the independence of the of the central bank. So for us, it is the main challenge to impose this idea, and we are working hard on this. And I expect that probably in the next 2 years we can show the results of this.
Yes, no, we know, and all the initiatives in some way or another to support communications, accountability are important. So here you can find a lot of knowledge in terms of trying to advise you in some way or another. Just to contribute to the discussion, we recently wrote a op-ed, a blog together with Andrew Powell on central bank autonomy. So here is in the chat, you can find it. So I don't want to monopolize the discussion. So if there are some people who can want to ask a question, please let me know. so they can turn on the camera and ask the question. Let's take this opportunity to ask a question to a governor of the central bank and a deputy governor. Okay, no worries. So probably I can try to think about another issue that is very important for us in terms of our own analysis, and it's about financial stability, of course. Margarita, probably she's very close to regulatory issues and supervisory issues. And one of the main issues that we're trying to understand is all the regulations on forbearance or moratoria. Probably there are some hidden risks on the financial sector. And we don't have all the information, at least it's not public, in terms of what problems are there and what can central banks do in that regard. So Margarita, what is your take?
Thank you, Eric. Well, there is no simple answer to your question, of course. So far, so good. We haven't seen any huge spike in non-performing loans across jurisdictions in Europe. Very recently as this morning and yesterday, we had our monthly supervisory board meeting. I'm representing in Spain, España. And we haven't seen yet a spike in non-performing assets. So on the one hand, this is good news, but on the other hand, of course, I mean, we really expect that most likely around first quarter of 22, we will see some non-performing loan increasing growth in the rates, right? And why is this happening? Of course, because of the huge measures that were in place by governments, institutions, and also from the authorities that recalled banks to make use of the flexibility of the regulatory requirements. So from the institutional and government side, we had the moratoria, not in all the countries, and in some countries for very limited and concrete sectors or portfolios. So this was not really exactly the same policy taken across jurisdictions, one thing. Second thing was in some countries, probably the ones with more fiscal space, they really took the direction of direct subsidies. And secondly, in other countries such as Spain or France or Italy, we took the route of a program of guaranteed loans. So all in all, with all those measures, beyond of course the ample measures from the monetary policy side and the very good financial conditions. So all in all, of course, with all those measures not withdrawn yet, not totally withdrawn yet, we see that, of course, the sectors are still a bit cushioned, and we haven't seen the scars, as I said earlier, in the economy. So if things go right and finally the economy recovers as we really project and we all have shared before, we don't expect a major, let's say, increase in non-performing loans. Having said that, we are constantly repeating the banks to be very prudent and conservative, and also to make use of any kind of early warning indicators, and also to start accumulating provisions just in case next year the situation is not as good as projected.
Okay, thank you, Margarita. And do you have the same impression, positive impression, Julio, about this? What about the small and medium enterprises in Peru?
Some sectors have been severely affected, those linked to restaurants, etc. But we have been surprised how overdue loans are pretty much at the same level that before pandemic. They increased during the pandemic, but they have returned to levels very similar. And the banks have been very aggressive in provisions, and still they lowered the profits a lot last year, but now they are at levels of profit almost as before the pandemic. And actually we follow very closely most of the institutions, and they appear pretty strong. The institutions that are weaker are pretty small, and they were pretty weak before the pandemic. And I believe it has to do with like good recovery and the support given to the firms through guaranteed loan programs made by the government, by the central bank. Actually, the expansion of credit to medium and small firms was almost 40% last year. So that allowed them to survive during the lockdown. And it was with a partial guarantee. So the banks lend us that money only to firms that they believe could survive at a very low rates, actually average of 2% nominal terms. Those that couldn't survive were not given the loans in spite of the guarantees because banks were putting part of the money, of course. No?
Thank you, Julio. And an important issue, I would say, it's important what type of sales can companies do in terms that we are trying to analyze what happened with in-person sales versus internet sales, and the resilience are really different among those groups. Alejandro, what is your take on that?
Well, let me highlight that we have stronger institutions, especially on the bank side, and that has shown. I think non-performing loans clearly surprised us, all of us, on the upside. That means that we were expecting something similar to what we have seen in previous cycles, financial or economic cycles. This was a very atypical crisis, sudden stop with a gradual recovery, heterogeneous responses, but nonetheless, I think it has been a crisis like no other. Second, it's hard to tell because we have been under a very significant amount of anesthesia, fiscal and monetary. So clearly the policy support has been significant. And I think we have the concern about financial markets. 2008 and 2009 was about the financial intermediaries. This time around, the support was more around financial markets and the risk aversion. So shadow banking is still an issue, and we need to have that on the radar screen. And finally, I think in terms of technology, I truly believe that we are in front of a disruptive process that can change significantly financial intermediation. And also, financial authorities have been mindful of, let's say, making a stronger and more resilient financial system of the usual suspects and the usual intermediaries. This is changing, and we're going to have a much more complex financial ecosystem. I call it ecosystem to say that it is broader than what we usually tend to understand. And I think the challenges are going to be significant.
Thank you, Alejandro. What about Colombia, Leonardo?
Well, in the case of Colombia, I think it's very similar to many other countries in the region and the world, that we had, as Alejandro was saying, a very atypical crisis, very strong crisis, very deep, but the recovery is being quite rapid. And I think for that purpose, to have a quick recovery after such a deep crisis, it has been key to have the financial system working well. In the case of Colombia, of course, the banks have had some increase in non-performing loans, but they have kept a very good solvency support. They have made provisions timely, and as someone says, in this case, they have been part of the solution and not part of the problem, and that is very, very important for a quick and sustainable recovery.
I said that, so that's good. What about Uruguay, Diego?
Similar than other countries, just we didn't see a deterioration of non-performing loans. Just at first time of the pandemic, we expect perhaps a credit crunch, but I think that we avoid it. Just we implement some guarantees scheme, some state guarantees scheme, and other tools that we made some measures with liquidity requirements, something like this. Just for us, just I mentioned, I expect a credit crunch at first time, but then we are in the same levels of non-performing loans than before the pandemic, and a little bit better. Just probably we expect, just we did some stress tests, and probably we expect some deterioration on the next months when we taper some measures. But just I understand that it was a good news in this crisis, different from another experience. As Leonardo mentioned, the financial system was part of the solution and not part of the problem. No, I repeat this a lot of times during last months.
And we believe it. So again, thank you very much. We ran out of time. So thank you very much, Margarita, Julio, Leonardo, Alejandro, and our special appearance of Diego in this important discussion. So now I'm planning to do a brief summary of what we have discussed during the day, and then I will leave the floor to Julio for a final word. So first of all, I have to thank everybody, to all of our speakers and participants. It has been a really good day with lots of food for thought for the next several months. So we're planning to summarize in a good way all the discussions and try to put together, of course, these assessments and policy recommendations in our future macro reports. We have heard about the risks that the global economy, and in particular emerging markets, is facing and will face in the months ahead. As your presentations and comments suggest, I think we are facing a period with very high uncertainty on several fronts. The first is the risk of inflation, of course, either temporary or permanent. A second important concern is how the US taper tantrum will be carried out and how this will affect emerging economies, which is especially relevant given possible effects on capital flows. Third and fourth are the fiscal and the political economy risks for emerging economies. And finally, we continue to be reminded that the pandemic is not over. We are in a race between the rollout of vaccines and the second variants, third variants, and also the new waves. We have to win that race. There are differences in vaccination rates within and across countries, and this emergence of new variants of COVID-19 mean that the pandemic's effects on growth might be less transitory than we would have hoped. Countries and sectors will recover at different rates, and this could pose additional challenges the months ahead, since I think we all agree that emerging markets do not have much room for maneuver today. After acting aggressively during the last year, they now have only very limited policy space. The pandemic gave us an opportunity to watch central banks deploy an arsenal of economic stimulus measures. They use conventional tools, but they also use unconventional measures such as quantitative easing. This means that central banks will have fewer instruments in the future because their balance sheets will be in a weaker position. Fortunately, though, it looks like the financial panic generated by the crisis has passed, and foreign investment is soon expected to be close to its previous levels. Still, foreign currency flows are not guaranteed, and central banks must maintain a solid financial position and stable inflation in order to secure a full recovery. For a moment, I would like to go back to inflation, which has occupied a prominent place in our discussion. I believe we must be very careful in the region. In particular, we are seeing a commitment between developed and emerging economies, and this is something new. We need to understand better if global or domestic factors are driving this increase in inflation. We must also consider how inflation might affect credit and the credit cycle. Credit has seemed to be independent of global conditions, as we discussed recently, which is good news, but it might present difficult challenges in the months ahead, and the circumstances surrounding credit will be different according to the composition of the financial market in each country. Finally, we have to ask ourselves whether inflation will remain a target of central bank policy 10 years from now. If monetary policy frameworks changes or not, central banks will need to play a very active role in the months ahead. Recovery from the pandemic doesn't only present challenges related to inequality, political factors, and the policy mix with the fiscal side, given the high debt level. Climate change and the use of digital currencies remain key aspects to think about. Central banks' autonomy will remain key to perform the policies needed to deal with these challenges. With that, thank you very much again, and thank you very much for staying until the end. It has been a long day for us. I very much hope to see you next year. Now, Julio, in Cusco. That will be great to see you there. And I will pass the microphone to our host, Julio. Thank you.
Well, thank you very much, Eric. Thank you very much, Marc. I believe it has been a very interesting and fruitful discussion. I would like to thank all the participants. And as you mentioned, Eric, let us hope to see each other in person next year in Cusco. Thank you very much for your attendance. Thanks. Bye. Bye.
Bye.
Bye. Thank
you. Gracias.
Bye.
Gracias.
Estén bien todos. Hasta luego.
Adiós.
Muy bien.